as we are all aware, um, the new syllabus of the institute will start this sitting, and there were some few things that were added and that were taken off the case study syllabus. One thing that we realized was that the um, the syllabus coverage has been restructured into about just five. The first one is strategic analysis. The second one is strategic choice. And the last one is strategy in action. We realize that these are the elements of strategy according to Johnson Schools and Whittington. Aside that, we have so the strategic analysis has a weighting of 20. The strategic choice has a weighting of 15. The strategy in action has a weighting of 25. So these are the strategic management syllabus coverage. All right. So after the strategic management side, we have the financial objectives side. That is the financial objectives as a strategy. And that is also 20 weight. And lastly, we have the corporate governance, which is 20. So with we realize that the examiner has added some things to some of the models, other things to, they have taken some of them off, right? And it will be very good for us not to really depend on the old syllabus. Okay. I mean, if you depend on it, fine. But if I were to be the examiner, or if you guys were to be the examiner, I'm sure you'd bring something that is new, right, in this year's examination. So let's critically look at the new things that have been added and not really waste our time with the old things that have been taken off. So quickly, let's start with our discussion. I mean, I want us to start from chapter one, brush through it, move on to chapter two, brush through it till we get to chapter 15. And that is why we are going to spend a lot of time today. So hopefully we finish everything. And also, if there is time after everything, we will look at the financial strategy and financial options questions or examples I told you guys about. If we don't have time, then we'd have to do it in our next meeting. I mean, when the case comes. All right. So, let me share my. Okay. All right. So we started off by looking at we introduced ourselves to strategic case study or strategic management, which is known as organization, strategy, and strategic objectives. So we looked at what strategy is. We realized that a lot of people have defined strategy. So we looked at what Chandler mentioned on strategy and also what Johnson Schools and Whittington mentioned with
Wait,
strategy.
man.
They said
Sure.
there is the direction and scope of an organization over the long time, which achieves advantage in a changing environment through its
Yeah,
configuration,
they have experience
resources,
page.
competencies.
Let me
Someone.
send you the link. What are you doing?
Okay, so yeah, so that is what we realized management or case strategy was about. We also discussed strategic management, where we said that when it comes to strategic management, we are looking at how businesses identify, how they select and implement strategy that will help them attain their long-term objectives. All right. But guys, we don't expect the examiner to ask us what case study is, right? Or what strategy is. But this was preparing us to the long-term plan of looking at the models and whatever was in store for us. So we look at how important strategic management is. We look at what strategic planning is. A very important thing that we also looked at was the levels of strategy, where we said that strategy can happen at the corporate level, the business level, and also at the functional level. So at the corporate level, we are talking about the for us. At the corporate level, we are looking at the overall strategy that's set for the company, and it's usually set by either directors or management, senior management. We have business level strategy, and also we have the functional strategy. And one thing that we said is that there should be a sync between these three strategies. So at every level that we talk about, they shouldn't be isolated strategies, right? There should be some form of a coherence or a consistency between or a flow between corporate down to the functional level strategies. So we explained what these strategies were. We also looked at the levels of strategic planning, where we spoke about the strategic planning itself, tactical planning, and also operational planning. And we realized that the strategic planning is the planning sort of that happen at the top, right? And this plan is cascaded down to tactical planning, which is usually short term or medium term in nature, which will finally cascade down to operational planning, which will have a detail of what each unit or each business activity is supposed to do. We also looked at the different approaches to strategic planning, where we spoke about the rational model, the logical incremental model, and the freewheeling opportunism. Okay, so with the rational planning, we mentioned that here we are looking at the planning that happens at the top and descends down to, the lower level activities, and it's usually long term in nature. It is usually prepared and set by senior management and all of that. When it comes to the logical incremental, here new strategies are devised or they are. Oh, guys, can you please mute for us? New strategies are dependent or implemented based on increments. So just like the incremental budgeting that we all know, the concept of incremental budget, right? That every year we tend to increase something, some strategy or something that we want to do. All right. And it's usually dependent on the strategic position that we want to be at in future. We also have the freewheeling opportunism model, where these guys are of the view that there is no requirement for us to get an or a formal strategic planning, right? And everything goes. We are not in a constant world. So we should just sit down whenever something comes up. We will just look at the opportunities that are coming and exploit them. If there are any threats, we will find ways and means to, curb or reduce the strength. So we realized that it was out of these Johnson schools and Whittington element of strategic definition that the examiner reclassified our syllabus, because these guys spoke about strategic position, strategic choices, and strategy into action. We also went on to look at the overall strategic objective of companies, where we looked at their vision and mission, their goals, their objectives, their strategies and strategic aims, their tactical plans and aims, and lastly, their operational plans and aims. So with mission, we realized that it is the overall purpose of the company, and we looked at how relevant it was for companies to get mission statements. So this is something that is examinable and it's something that we are supposed to know as candidates for the case study paper. We also looked at what vision was. We looked at goals and objectives. We discussed that goals are aims for the entity to achieve, and these are usually expressed in narrative terms or in broad terms, right? We also discussed that objectives are derived from goals. So they are subsets of the goals that companies set. Okay. And usually objectives are in the form that can be measured. All right. And because of that, they are supposed to be smart. So with smart, we are saying that they should be specific or stated clearly. They should be measurable. They should be agreed upon. They should be realistic, and they should be time bound. We spoke about who decides um, goals, mission, and objectives, right? We realize that usually all of these things are dependent on the expectations of management, sorry, expectations of shareholders and also the board of directors, right? Because it is from the expectation of the shareholders that the board of directors will set these goals, right? Remember, we spoke about the agency theory, which clearly says that the board of directors are agents of the shareholders, and whatever they are doing should be in favor or should be in the interest of the shareholders. Okay. So we also discussed stakeholders that are available, and we discussed stakeholders, and we said that stakeholders will usually depend on the particular entity, right? Because the stakeholders of a bank will definitely or will clearly be different from the stakeholders of an insurance company or a fast moving consumer goods company, right? So realize that we have internal stakeholders and external stakeholders. We have a whole lot of stakeholders. We have shareholders, we have bondholders, we have bankers, we have customers, we have directors, employees, and what's not. We discussed the expectation of these stakeholders, right? What are these guys expecting? Because when we say that someone is a stakeholder, we are looking at their interest in a particular company or what is their interest. When it comes to shareholders, what do they expect? Shareholders expect their share prices to grow. They expect that dividends are stable or are increasing over a period of time and all of that, right? When we talk about directors, what do they expect? They expect remuneration packages to be very high, likewise, senior managers and employees. So, all these stakeholders have expectations. If you are an employee, you have expectation. If you are a banker and the company has come for a loan from your bank, you expect that the company is profitable in order and also liquid in order to for them to pay your interest and your principal repayments, right? So every company or every stakeholder have their expectation, and it is out of these expectations that we realize that sometimes in trying to satisfy the needs and the expectations and the interest of one stakeholder, we tend to step on the toes of another stakeholder. Okay, and my key example is when it comes to um, salary increment, right? If we increase salary for employees, it is a very good thing for the employees, right? Especially taking into consideration the economic challenges and all of that. But remember that salary increment is going to reduce the profit of the company. It is going to reduce the profit that is attributable to shareholders, right? So by increasing salaries, we are stepping on the toes of shareholders. And that is how come managers are supposed to plan relationship between stakeholders by taking into consideration the stakeholder mapping. So with stakeholder mapping, we said we have two types or two matrices. We have the position importance matrix and also the power interest matrix, which is known as the Mendeley matrix. Guys, every model is highly examinable. So if you are forgotten, let this be a refresher for you to, for us to remind ourselves of what we have learned. So with the position importance matrix, we are looking at the position of the stakeholder or a particular stakeholder on an issue and how important that particular stakeholder is. Guys, can you please mute when you join? Okay, thanks. So we are looking at how important, guys, this is very examinable. So please, I mean, every model in case study is examinable. I mean, until we look at what is in the case, everything can come, right? And now we don't have the precinct. So please let's follow as we are trying to remind ourselves of the things that we have learned earlier. Because, I mean, by joining this class, we are joining to refresh ourselves, right? Refresh ourselves of the things that we have learned. Because by now, this is not the time that we are going to learn all of these. We are just reminding ourselves. So, as I said, the position importance matrix looks at how or the position of a particular stakeholder on an issue and how important that particular stakeholder is. So here we have two dimensions. We have the position and also the importance, right? So a particular stakeholder might be opposing a particular issue, but that stakeholder might not be important, right? A stakeholder might be opposing, but might be important. A stakeholder might support, but might not be important. A stakeholder might not support, but might be important. As management, we have to look at the stance or the position of a particular stakeholder on the issue at hand and also how important that particular stakeholder is. If the stakeholder is opposing, right? If the stakeholder is opposing, and if you recall, I admonish you guys to know the models, know how to draw the models, so that sometimes you might forget about what you write, right? You might have forgotten about what you write, but if you know the model, if you know how to draw the model, you just use the model to explain your point. Okay, good. So a stakeholder might be opposing. So a stakeholder who opposes an issue, but it is but that stakeholder is not really important. We call that stakeholder a problematic, right? But if the stakeholder supports the issue, but that stakeholder is not important, that stakeholder is in the low priority category because in as much as you are supporting the issue, like you don't really have any importance. So we keep you on the low. The very crucial one is the stakeholder who has power, who is important, and who is opposing the particular issue at hand. And that we call the stakeholder antagonistic, right? That stakeholder is very important to the issue we are discussing, and that stakeholder doesn't like it at all, doesn't like the idea. For instance, we want to increase salaries. Shareholders are opposing it. We can refer shareholders as antagonistic because shareholders are very important. So if they are opposing the issue of or the aspect of or the idea of management to increase the salaries of employees, then we can say that the shareholders at this particular point are antagonistic. And we also have the supporter who will support it and also is very important. So please know the model, know how to draw it because sometimes the examiner even asks us to draw it, right? Aside that, Mendeley also brought the power interest matrix, which is similar to the importance position matrix. But here we are looking at how powerful the particular stakeholder is and how interest or the interest that the particular stakeholder has in the matter that we are discussing. So the question is the stakeholder we are discussing powerful? Is the person or is the stakeholder strong or weak? Are they really interested in the matter at hand or they don't really care? They don't really have any interest, right? So this is the Mendello position, right? The last time the examiner brought these two models, he brought them together. So it wasn't just one. Together, we're supposed to draw it for 10 marks. I think it's April 2022. Yes. So let's know how to draw it. You never know what the examiner will bring, right? So with the power interest matrix, if the stakeholder is weak in terms of power, the stakeholder is not powerful, but they have no interest also in the matter we are discussing. You keep them minimal informed. You tell them that, oh, this is what we are doing, oh, okay? We know we don't really mind, but yeah, we are just informing you. So, I mean, minimal effort, sorry. When it comes to stakeholders who are powerful, but they don't have any interest in the matter at hand, you keep them satisfied, right? They are powerful, but they are just not interested in what is going on. So you make sure that whatever you are doing do not affect them negatively, or do not make them worse off. So you keep them satisfied in as much as they are not interested in the issue at hand. Make sure that the issue doesn't transcend to come and affect them, right? If the stakeholder is weak, but they are very interested in the matter, like you don't really have a lot of power, but you're interested. So we just keep you satisfied. We keep you informed that these and these are what we are doing. Because you are interested, we'll keep you informed so that you know what is going on. We are keeping you informed because you are not a key player. You are not a key player because you don't have strong power as a stakeholder. So we just keep you informed. If the stakeholder has very interest or very high interest in the matter at hand and is very powerful, we call them the key players. Good. So other things that it's under the organizational strategy and strategic objective is the corporate values and culture. Those of you in my class, you realize that we did it in another topic, but it's part of chapter 1 in this syllabus. But we have done it, we treated it, just that we treated it in another not this topic. So, but since I am just using the book, let's go through that flow, right? We discussed about how important corporate values are and corporate cultures are. And we said that there are some things that shape culture in a particular organization. That is how come we discussed the cultural web. That's how come we discussed the cultural web. So there are a combination of factors that will shape the organizational culture. One of the things is the formal structure and size of the company. Remember that if the company is small in nature, everybody will tend to know themselves. So the CEO will know you, the cleaner, because it's not really a big company for us to have, let's say, different offices also. But if the company is big, realize that sometimes it will take you years before you can even see the CEO, right? Especially if you are not in the same building that the CEO is, or you're not in the same, let's say, floor that the CEO is. So the structure, the leadership of the company also influence culture. Usually, these leaders come with their own style of leadership, okay? Especially if you appoint new key management personnel, they come on board with their own idea of managing a company, right? And that might change the culture of a particular company, the location of the company, the business environment. With the location, you know that some things that we do in Ghana affect us as Ghanaians, and that is our culture. So if the business is situated in Ghana, you know that we do things differently from how other businesses do their things. So as one company will be in Ghana, the same company will be in another country, but even or in as much as they have the same principles, in as much as they have the same value chain and all of that, there'll be some culture that will be different. Okay. You can take the big four firms, for instance. Even though KPMG Ghana, KPMG US are the same KPMG firms, right? There will be some things that will be only specific to Ghana because of our culture as Ghanaians, right? Yes. And also business environment and also ethics. One other thing that the examiner introduced is what we call the Handy cultural types. So there is this guy called Charles Handy who described what we call cultural stereotypes. So there are some people who have a power culture, other people have a role culture. We also have a task culture and also a personal culture. So with the power culture, you realize that someone's power will come from the position that the person has been assigned to, right? So, and usually it is during entrepreneurial stage. Remember the greenness model, right? During the entrepreneurial stage of the organization that this power thing will rule, right? So, people would want you to call them boss, 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 and all of that. We also have the role culture, right? With the greenness model, after the creativity stage, we move on to the next stage, which is the directional stage. All right. So that is where the role culture comes in, and it brings on board something with role crafting, right? It brings on
May online class.
Guys, can you please mute? Can you please mute for us? Okay. So when it comes to the role culture, the responsibilities of every individual is, enshrined in the job that they have given them. Okay. And we also have the task culture, which is focusing on, tasks and how individuals get tasks completed efficiently and effectively. We also have, lastly, the personal culture, which is also known as the existential culture, which looks at the individual culture, right? Or what we call the personal values. We also discussed the cultural web, right? And the paradigms of the cultural web to realize that we have routines and rituals, we have stories and myth, we have symbols, we have power structure, organizational structure, and control system. And remember that this cultural web was also proposed by Johnson, Scholes, and Whittington. We also discussed the approaches to organizational strategy, where we discussed the system-based approach, the resource-based approach, the core competencies-based approach, the rationale-based approach, and also the emergent strategy. So we also moved on to go and talk about ethics and strategy. where we discussed ethics and accountants. So here we started looking at, the various forms of ethics, descriptive ethics and normative ethics. Please hold on as I project. Right. So with the descriptive ethics, with the descriptive ethics, we are looking at the moral or just the definition of moral principles, right? So just like a descriptive essay, right? So we are trying to describe it. What is it? What it is? What is this ethic saying? What is this ethical behavior? Is it good or is it bad? We are not really trying to suggest what is ought to be ethical. Okay. We are just describing a particular ethical stance, right? I don't know if that is clear. So we are just researching and looking at what a particular ethics is about. We are not really saying that, oh, the ethic is supposed to be like this, but you guys are doing it like this. No, we are not trying to compare. We are not trying to be what we are not trying to look at what is ought to be and what you guys are doing. No, we are just describing it, and that is descriptive ethics. So we are researching into the moral attitudes or positions of individuals and groups and their beliefs about what is wrong and what is right. We are just describing the ethical beliefs. We are not trying to suggest what ought to be right and what ought to be wrong. That's descriptive ethics. We also have the normative ethics, which involves establishing moral standards. So here we are establishing what ought to be the standard and indicating what people should do that is right and why they should do that and what aspects of behavior are wrong. You know that most of our religious groups have the normative ethics because based on their principles, their religious principles, they set moral standards on what is right and what is wrong and why people are supposed to take what is right. We also discussed other aspects of ethics where we spoke about business ethics, professional ethics, and personal ethics. So, with business ethics, these are the principles that guide institutions and people that work in the world of business, the work environment. What are some of the things that guide us? What are the moral principles? So we realize that mostly companies will have their core values and their ethical principles. And most of these things will be enshrined in their staff handbook and all of that. We also have personal ethics, which talks about the intrinsic moral principles that govern how an individual interacts with other people. So here we are talking about Ebenezer and how Ebenezer is like, and how Ebenezer is motivated to do certain things, right? Not necessarily when he goes to the business place, but what he is intrinsically. We also have the professional ethics, which is guiding professionals. So accountants, lawyers, doctors, architects, the things that define us or that guide us, that is what we call the professional ethics. And as you guys are aware, the code of ethics of the IESBA, which the ICA has adopted, is something that is supposed to guide us as accountants. We also went on to look at ethical and moral dilemmas, where we said that sometimes it's very hard for us to choose a particular course of action because you don't really know what is ethical, or you might be confused about what is ethical and what is not ethical. And sometimes you might want to bend the rules because Charlie, if you really want to be ethical, it might not go well with you. Remember we spoke about the hands principle, right? The hands example. Okay. We also discussed how ethics is different from law. that, you know, something might be ethical, right? But might not be legal. Something might be legal, but might not be ethical. So, but usually things that are ethical are legal. But some things can be unethical, but might not be illegal, right? Some things might be unethical, but might not be legal. Sorry, might not be illegal. Because it might not be illegal because we don't have any, anything enshrined in our laws that they are wrong, but they might be wrong ethically. Okay. We also moved on to discuss the moral philosophies, where we discussed the theories of ethics. So we looked at the consequential theories and also the non-consequential theories. We realized that the consequential theories are known as the teleological theories, and also the non-consequential theories are known as the deontological theories. So with the consequential theories, as the name suggests, we are looking at the consequence of the action. So these guys are of the view that something is right if the consequence is right. Regardless of the course of action that you took, if the result is right, you are right. So this brought us principles like utilitarianism, ethical egoism, where with utilitarianism we are saying that something is right if the outcome is good for a lot of people. If you are trying to maximize the utility of a lot of people. And with ethical egoism, when you are trying to advance your own interest. So you are thinking about yourself alone, right? And that is also one principle under the teleological theory. So just know that that is also known as the results-based theory, where we are saying that of all the things that a person might do at a particular period of time, the morally right action is the one with the best overall consequences. So they are of the view that nothing is inherently wrong. It all depends on the results of your actions, right? So remember that we spoke about a man whose wife was dying of cancer, and it was only one pharmacist that had cure to the person's cancer. Even though the pharmacist spent a few dollars to produce the vaccine, the pharmacist was selling it for about 2000 USD, right? So the guy went to the pharmacist and asked that, oh, please give it to me. Let me pay you $1,000 down payment, and I'll be paying the rest or the remaining $1,000 in installment. The pharmacist insisted that the guy brings all the money before the vaccine or the medicine is released to him. At the end of the day, the man broke into the pharmacist's room and stole the medicine and gave it to the wife to survive, right? So with this one, the teleologist will agree with the man, will agree that, oh, what the man did was right. How can you produce vaccine for $20 and sell it for $2,000? That was outrageous. I'm not even looking at the course of action. I'm not looking at the fact that I broke into your room. The end result is what matters. After all, my wife was saved and all of that. You get it. So he will look at the end result. But the deontological people will look at the course of action. Why did you break into someone's room? I mean, regardless of what the person was saying, you don't have any right to steal, right? Aha. So that's the confusion when it comes to these two theories. So this same teleological approach is what businesses used when they are using the shareholder approach, okay, where they are just justifying their profit motive. They don't care about what is happening in the environment. They just think that they were set up to satisfy or maximize the value of their shareholders. Okay. So that's all they think about, not really thinking about the employees, not really thinking about the community and all of that. Okay. So let's look at the main criticisms when it comes to the consequential theories. It is difficult often to predict in advance what the consequence of an action might be. And also, it can be used to justify someone's self-interest, right? Like everyone wants money, right? I would just go and kill someone and get money and say that because I was hungry. If the consequence is what we are talking about, I was hungry and I killed to get money to feed myself. So in these people's mind, it is good to kill and feed someone or feed yourself or feed your family. That is the Robin Hood mindset that employees are making more money. Let me steal from them and give it to poor people, right? Okay. And people can do this to justify their actions, right? These guys might steal 100 million US dollars and give out, or let's say 1 million US dollars out, right? That I gave it out. Meanwhile, they are keeping more of the money, right? So they will be doing this to justify their own self interest. So we also have the non consequential theories, which has the view that always do the right thing. Do the right thing because it is right, regardless of the outcome. So just like the hens theory or the hens principle that we discussed, the guy shouldn't have and gone in to take the medicine because like he should have watched the wife to die. Can you imagine? Yes. So that's what these guys are doing. And also do not do the wrong thing because it is always wrong. So we also went on to look at the criticisms of this, where we said that it can be very difficult to accept that a decision or an action is morally right if it has undesirable consequences when an alternative course of action might offer beneficial consequences. So, and that's why some people copy in exams because they know that, hey, so I'm sitting down to fail. Someone is sitting beside me, the person is writing or has written the answers on a particular sheet of paper. The person is done writing. I can just take it and also write it. So am I going to sit down and fail? So sometimes it's very difficult to accept it that, hey, I am failing. Okay, let me fail in peace. It is very difficult to accept a particular decision that, oh, it is not morally right to copy, so I won't copy. How many of us will do that? That, oh, let me just sit down and fail in peace, even though there is opportunity for us to do what is morally wrong. You get it? So that's the main criticism. Like your wife is dying. You can break into, there's opportunity for you to break into the pharmacist's room and go and steal for your wife to survive. Will you sit there and say that it is morally wrong and say that I don't have the money? So let's just sit down. So that's the criticisms for these theories. And also, they are saying that do the right thing always. What is the right thing? What is right? What is right? Because something might be right in Ghana, but might not be right in the US. Something might be right with Christians, but might not be right with Muslims. So, how do we clearly state what is right? And there's a confusion when it comes to the non consequential theories. We also discussed situational ethics, that is based on the view that what is right or wrong is dependent on the particular situation. So these guys there, they're saying that you can kill, oh, but it depends on the situation. So you can kill and be right, but can kill and be wrong. You get it? So this is what these guys are also trying to say, that there are no universal rules when it comes to morality, and that each situation is unique and should be treated differently. The main criticisms are that there's no consistency in this. Okay, how can you tell me that one killing that two of us have gone to do, I can be right, another person can be wrong? And also, it can be argued that there are no ethical or moral guidelines at all. Okay, because we don't really have a standard if you say that it depends on the situation. We also went on to look at absolutism and relativism. But before that, let me give us opportunity for us to ask any questions we have. I mean, before we move on. Okay, as I said, I mean, by now, most of us have gone through the book or the notes that we have over and over again. Okay, you guys are fortunate enough to have someone who is facilitating for you. As I told you guys, those in my class, I mean, some of us didn't get the opportunity to have tuition, so we had to do this our own or do this ourselves. Remember my time? I think I went through the book like three times before I went to write the exam. So the first two was normal studies. The last one, I opened the book and I was just going through. Do I know this? Yes, I know. Let me move. Do I know this? No, I don't know. Let me revise. Then I revise. I'll move on. Do I know this? Yes. Do I know this? No. Let me revise. That's what I did the last day I went to write case study. And because of that, the things were fresh in my mind. And please, you can do this if you have already learned it. If you haven't learned it, it's going to be time consuming. If you have learned it even at least once, if you have learned everything at least once, you know that as you are going through the book, there will be some of the things that you know that this one I'll remember. Let me move on. Okay. And I feel like personally, I think that that last minute revision is very critical and crucial for your success. Because one thing about case study is that it's too plenty, right? It's plenty. So please, I know that some of us are writing four papers, okay? After you write the three papers before case study, just sacrifice, right? The last day, I mean, the day that you finish the paper to case study to the case study period or the case study paper, just do that, right? Take the notes if you have it. Do I know this? If you know it, if you think you can remember, just trust yourself that you can remember. You will remember, trust me. Move on and look at the things that like you have no idea about or you have forgotten totally, right? And you pay more attention to that. And trust me, we are all going to sail through this paper. So let's move on to the theories of absolutism and relativism. So with the absolutism, there are no absolute moral standards against which the morality of actions can be judged against. Okay, so right and wrong are recognized by objective standards that apply universally to everyone. So just like Christians, Muslims, and other religious organizations, there are standards that are there. These are absolute standards. The Christians might say that do not fornicate. The Muslims might say that do not drink alcohol or anything. These are principles that are there, regardless of where you find yourself. They are the principles. They are objectives, clear cut objectives that apply universally to every Christian or every Muslim. There comes Gen Z concept, which is relativism. They are saying that, no, how can you tell me this story that absolutism is the way to go? No. Here, there is no objective or absolute moral truth, and there are no universal standards of morality. They are saying that, no, you can't tell me that what is my ethics is my ethics. You remember that thing, or you know that thing. What is my ethics is my ethics. We don't really have any moral, universally acceptable standards. So they are saying that morality is relative and sometimes it's true, especially to ethical norms that are accepted by society at a particular point in time. Guys, look at the issue of um piercing, right? Like piercing, like so piercing of the nose, piercing of the ears, I mean additional piercing of the ears, anklets, and those things. At first, it used to be odd, right? It used to be strange. And I even learned that people who used to do those things were called, in quote, prostitutes. Guys, I'm not trying to defame anybody. But that was our view some time ago. Now, I mean, piercing is normal. I don't know, but piercing is normal to relatively a lot of people now. That some companies will even allow you to bring your piercing. In fact, you see some managing directors having like their ears pierced about 10 times. You get it? Some things, the relativism approach is saying that things will change. So if the absolutism are saying that by force piercing is wrong or additional piercing is wrong, these guys are saying that no, just give us some time. It will get to a time that we will accept it, right? And that's why people are of the view that it will get to a point that even Ghanaians and Africans will accept the LGBT community and all of that because they believe in the relativism approach to ethics, that it's just a matter of time. Culture will change. Okay. Let's talk about business ethics. So here we are looking at the principles, the values that will govern and guide firms and companies. And we know that firms are not just the structures that are there, rather the people in the company are also parts of the firms. So the things that they do, management, what are they supposed to do? Employees, what are they supposed to do? Okay. So, for instance, a marketing unit of a firm may consciously mislead customers. Look at the adverts that companies run, right? It might just be persuasive for you to come and buy, right? So they might be putting across something that the products are not really about, and that is not ethical. Okay, so these business ethics guide businesses as a whole. We also have illegal corporate behavior where a company, whether intentionally or unintentionally, they become involved in, illegal activities. So when you find yourself in a place like Ghana, okay, you might be doing it unintentionally, paying bribes, because if you want to win the contract, you have to give someone money. Even the person will request for it that, oh, here, that's how we do it here. So just give me something, let me give my bosses small so that we think about it, right? So ideally, bribery is wrong, but some companies intentionally or unintentionally involve themselves in some of these things. Okay, all right. So one other thing that we want on to look at is the models for ethical judgment and decision making, where you know we kind of have a framework that will guide us to make ethical decisions. We started off by looking at system development ethics, where we said that in as much as businesses are exposed to ethical risk, okay, that is the risk that some of their managers or some of their employees will act in an ethical manner that will affect them. They should have they should have systems in place, to minimize their exposure to ethical risk. And that is what we call the system development ethics. We also went on to discuss the about two ethical decision models. That is the Takes 5 question model and also the AAA model, which is the American Accounting Association model. So with the Takes model, it's saying that whenever you are faced with a particular decision, whenever you want to make a decision, you ask yourself, is it fair? Is it profitable? Is it legal? Is it right? And is it sustainable or environmentally sound? We then moved on to American Accounting Association model, that whenever you want to make a decision, you ask yourself what the facts are, what the ethical issues are, what the moral principles and the values are. Are there any alternative course of actions? Are there, or which one is the most consistent approach or most consistent course of action, right? I mean, after we have determined the alternative courses of action, which one is the best that we can select? And what are the consequences if we select any of the courses of action? Then we will settle on the decision that we want to make. So we also went on to discuss accountants and ethical problems since we are accountants. We discussed the models that the IFAC has suggested. We realized that there are 6 stages when it comes to um, models that will help us deal with threats and safeguards. Okay, so you recognize and read and define the ethical issues, you identify the threats to compliance, you assess the significance of the threats. If the threats are not significant, you consider additional safeguards that could be used. Then you reassess the threats. Then you make the decisions about what to do. Please know some of these things since they are very new to the syllabus. Right. We also went on to discuss the mirror test, that if we choose to, or if accountants, we choose any course of action, are we able to look ourselves in the mirror and see a person who has acted in a moral way? So I even used staining your white clothes as an example. After a particular decision is made, this mirror test is asking us to reflect on it and see if we went wrong in terms of our ethical principles as accountants. Then we went on to look at the core elements when it comes to ethical reform. Sometimes there has to be a reform in our ethical framework as a company, even as a country. Okay, what are some of the measures that we can do when we want to, reform our ethical principles, our mindset, and all of that? So we have leadership and tone at the top. That is the very important issue, right? Imagine if your leaders are unethical. Like, you can't do anything. And that's why a lot of people resign from certain companies, because they think that no matter how they strive to be ethical, their bosses are going to, make them override certain controls and certain things in the company. Our missions and strategic objectives should be something that will push us to be ethical. We should improve upon our organizational culture. There should be accountability, and also our remuneration should affect, the work that we do. Imagine paying someone, the work that, or the amount that they are supposed to get. There's no way they might try to cut corners and do certain things that are unethical. We also have to have consent for customers, employees, and the society. And that are some of the core elements when it comes to, you know, ethical reforms. Once again, this is a very new area. So let's look at it. Now, we also went on to discuss sustainable competitive advantage and sustainable community benefit. We discussed these two things. Okay, so please look at it also very well. These are new concepts that are introduced by the institute for us to look at. Let's move on and look at CSR and EDS. So, corporate social responsibility and environmentally driven strategy. I mean, ESG is the new, the order of the day when it comes to accounting, right? And financial reporting. Everyone is talking about ESG, everyone is talking about sustainable reporting. So let's look at what the examiner wants us to know on CSR and EDS. As I said, I hope this is helping us, the areas that we think we need more work to do there, the areas that, we are okay with, right? So, guys, if you have learned the thing, please don't see this as a waste of time, right? Because I know that some of you have gone through the thing that everything I'm saying today, please just bear with us, okay? So that we help ourselves, right? Because some of us, we need time, all right? We need to be exposed, okay? We need to refresh our minds with the things that we have already learned. All right. So with CSR and EDS, we started by looking at CSR, what CSR is. So this is the responsibility that firms will, recognize, or firm recognized for acting in a socially responsible manner. So when we talk about CSR, it refers to business decision making that are linked to ethical values, compliance with legal requirements, and also respect for people, communities, and the environment. Very key, the environment. Respect for the community, respect for the people that are working for you, and respect for the environment. Some people or some companies are doing a lot outside. They are caring for the community, they are thinking about the environment and all of that, forgetting the employees that are working for them. Guys, your CSR won't be CSRing if you are not thinking about your employees, right? Some people just want to show off, just want to paint a good image out there. a good reputation out there. So they would just go and help a PhD community because there was an explosion there, because there was a flood in the Volta region. They'll go and help them. Because there was this one here, they'll go and help them to look good, right, in the community that they are or in the country that they are, forgetting the employees that are working for them. So one key and one very important thing about CSR is treating employees fairly and promoting the well-being of employees. Guys, I watched something yesterday on PwC Lazenberg's website. Like, you'll be surprised. The place that they are showing you as a workplace, you'll be surprised. If everyone is getting this conducive environment, everyone will want to work there. Okay, they have games that if you are working in you want to release stress more, you can just go there and go and play. They have a bed that you can go and rest more. They have, you get it. Imagine having these things at your workplace. Like, if companies are doing this, that is what we can say that they are promoting CSR. But when we talk about CSR in Ghana here, we are talking about helping people outside the company, forgetting the employees that are there. Okay, forgetting that we are supposed to treat employees fairly, we are supposed to respect employees, we are supposed to promote their well-being. Right? Good. So it's not just about the employees. Dealings with customers are supposed to go on well. Respect for human rights, the environment, the community that we operate in, and all of that. So broadly, CSR is related to concern for employees, concern for the environment, concern for communities, and also acting ethically in our dealings as a company. So we also looked at the limitations of CSR, as I told you guys while we were learning. In as much as you are looking at the principles, please look at the limitations, the weaknesses, the strengths, and all of those, right? Because sometimes the examiner will ask you 8 marks. I mean, the main concept will be 8 marks, and the advantage, the disadvantage will be 2 marks. Guys, 2 marks is something when it comes to CA. In fact, my first time I wrote management accounting, I got 48. So if I had gotten that 2 marks, I would have gotten 50 to pass. So please don't say that, oh, it's just 2 marks. No, please look at them because those 2 marks can help you somewhere. Okay, right. So with the limitations, small companies might adopt some CSR practices in their local communities, but do not have the skill, the scope, and the resources to act more widely. So you see that you realize that, oh, this is a small company in Cape Coast. Let's say Kotokraba or Abra. And guys, I know these towns because I went to school there, right? So they might just be there giving food to, homeless people in that community because they don't have the money to extend their CSR activities to other people, right? So they might be limited in terms of resources. And some people also argue that, why are we supposed to help people like this? Why are we supposed to help people in the community? Why are we supposed to make roads? Why are we supposed to build schools? That is the work of the government. So let's not even think about it, right? So some people also argue that that is the work of the government and companies are not supposed to look at it. ESG is now a very famous concept in accounting, right? Nowadays when you go to check people's LinkedIn profiles, they are saying that, oh, I am ESG enthusiast, I am this, I am that. What is it about? So ESG, we are talking about the environment, the society, and governance. So with environment, we have some strategies that companies adopt. That is, trying to minimize the effect of their operations on the environment. You get it? Taking measures to protect the operations of the company from hazardous activities like floods, wildfire, hurricanes, and all of that. And also pursuing opportunities that will protect the environment by switching the company's product and services portfolio to make them less damaging, right? And that's why sometimes or nowadays you see Voltic, even a Voltic bottle. I don't know if you guys have seen now, it is compressible, so you can compress it. Okay. At first, their bottles didn't used to be like that. Now they want to think about the environment. So that when you finish drinking, you just compress it from the top to the bottom. So they just put it in the bin or a recycling bin that they'll just come for it and go and recycle it. With the society, we are talking about strategies or social strategies that will go in the favor of employees, in the favor of suppliers, in the favor of the communities. With governance, we are talking about the corporate governance structures and the processes that are available to the company and how the companies are working in terms of promoting their corporate governance soundness and also adopting best practices when it comes to corporate governance. We said that even as much as some companies do not want to, engage in um, CSR and ESG, it really have competitive advantage for them, right? Imagine I told you guys the last time that people will just buy certain products because they know it's going to help someone, right? Especially um, my mom will buy Awake because they have written that for every bottle you buy, one pessoa will be donated to the National Cardiothoracic something something. You get it? And people who have this mindset will buy it because they think that, oh, after all, these bottled water, they are the same, right? They are the same for every. It's virtually the same. So if my one pessoa will go on a long way to help someone, why don't I buy it? So in that case, you are just trying to, get more sales, okay? Helping you to gain more competitive advantage because of the CSR activity that you have decided to engage in. We also went on to discuss um, social and environmental footprints. So with this, we are just like footprints, right? Imagine you've gone to step in paint. If you are going, you see the footprints being the paint that you step in. So we are talking about the impact that an entity has on the environment and what they do to reduce this impact. We spoke about carbon neutrality. We spoke about social footprint. We also went on to discuss sustainability and accounting for sustainability, which is also new to this syllabus. It's something that we have to look at as accountants, right? So when it comes to sustainability reporting, we all of us are aware that the International Sustainability Standards Board not so long ago issued their first two sustainability reporting standards. That's IFRS S1 and IFRS S2. The examiner doesn't say anything that, hey guys, know the standards, so no. Okay, they are not requiring that we know these standards. Okay. All right. So another thing that we looked at is what we call the triple bottom line reporting, right? Usually companies report taking into consideration their economic indicators in the sense that they will report on their sales, their revenue, their profits, their earnings per share, dividend per shares, and all those economic indicators. Then 1994, there is this guy called J.L. Kenton who developed the triple bottom line that it's not in as much as companies are trying to show us the economic indicators, they should also show us how they are doing environmentally and also socially. So the three bottom lines are the first bottom line or the main bottom line that we know, which is the economic indicator. The other bottom lines or the two other introduced bottom lines are the environmental indicators. That is how you are minimizing the release of toxic materials or pollutants into the environment, how you are renewing renewable resources, how you are recycling products. Tell us, let us know. When it comes to your social indicators, how are you fighting bribery? How are you fighting child labor? How are you fighting human rights? We discussed the weaknesses of the triple bottom line reporting. We also went on to look at a very crucial topic, which is sustainability assessment model and the full cost model. So, with the sustainability assessment model, we said that it is measuring the implications of, the impact on sustainability of a product over its useful life. So, how well, or how are you taking into consideration sustainability when it comes to you extracting raw materials, you producing it, you selling it, and all of that, right? When it comes to selling, some people can argue that, oh, now let's use electric cars as our delivery vans, right? Because we know that, I mean, by using those cars, we are not going to pollute the environment that much. And we said that it is out of this sustainability assessment model that the full cost accounting is born, right? So the full cost accounting is the measurement system that is supporting the sustainability assessment model. So the model is there, but the full cost accounting will come and measure how well we are doing. So we discuss all of these. We discussed the four steps of applying sustainability assessment model. We said that you define the scope of the assessment, you specify the scope of the assessment, you identify and measure the external impacts of the product, the process, of the company, and lastly, you convert non-financial impacts to monetary value. We also went on to discuss ISO 14000, that is the environmental management system, and the EMAS. Okay, so here we said that some companies have systems in place, right, that helps them monitor their impact, or how impactful their activities are on the environment they're operating. We discussed the ISO 14000 certification and how it is very important to companies, how it benefits companies. We discussed all of them. We discussed environmental management accounting, where we said that we have redefined management accounting, right? I mean, the normal management accounting that we know that looks at some things like activity-based costing and those things, all of them have been redefined, taking into consideration the environment. Okay. So we looked at the framework for environmental management accounting and also some of these techniques. So we realized that some costs have been redefined, that we have conventional cost, potentially hidden cost, contingency cost, and also image and relationship cost. We also have environmental activity-based costing or accounting. So this is the normal activity-based costing or accounting that we know. But here we are taking into consideration the environment, right? So we will have environmental related cost, we will have environmental related activities, and also environmental driven cost. We also look we also know the idea and the concept of the life cycle costing, which is the LCC, which has the introductory, the growth, the maturity, and the decline stage. Here, we are attaching environmental to it in the sense that, as usually we look at the product in isolation, but now, because of our concern for the environment, let's take into consideration the environment. How is our product going to affect the environment at the introductory stage? How is it going to affect the environment in the growth stage? How is it going to affect the environment at the maturity stage? We also discuss the input output analysis, that ideally whatever you are inputting in a particular business process should come out. Garbage in, garbage out, right? Right. But sometimes it's not like that at all, especially when it comes to production. Okay. Because you realize that the number or the amount of raw materials you put in, some of them will go waste. Some of them might be reusable to the extent that you can put it at the initial or at the beginning of the process again for those process or for those products to go to the end, right? So let's say um you inputted the raw materials, right? Some of them fell on the ground. you can put those same materials inside again, right? Right. So there's the input output analysis that usually the 100% input that we get into the production facility. About this is not a standard though. This is just arbitrary, right? This is not a rule. Okay, this is just an example. So let's say 60% will be the output. We can use 20% as recycling. It's either we reuse it ourselves or we can sell it as scrap. Okay. And some of them we might have to dispose it as waste because we can't use it for any other thing. And sometimes some of them will be unaccounted for because we don't really know where they have passed. All right. Good. We also discussed social and environmental audits. Okay. Everything is environmental now to the extent that we have environmental audits. And we said that it can mean a formal audit on an environmental management system. Remember, we spoke about the environmental management system. So you can conduct or you can request auditors to come in and check if the system that you have to monitor the environment or your environmental activities are operating effectively, right? There may also be a check on the company's compliance with environmental and social legislation and regulation. So this will be a compliance audit in the sense that the auditors will come and check how you're complying with the environment or some regulations that are there, especially if it's a company that falls under the jurisdiction and the scope of the EPA, right? Or the FDA. They'll just come and check as auditors. It could also mean an internal check of a particular aspect of the company's environment management system, such as its system for measuring the environmental cost of waste. So here we are not coming to check the environmental management system as a whole. We are just coming to check an aspect of the system. And it could also be the verification of social and environmental information that will be included in a published report, right? So remember that these companies publish reports on their ESG and their CSR. So it can be an independent report or it can be part of the annual report. Now, auditors can come and certify that, oh, whatever the company is saying that they did with respect to the environment and their corporate social responsibility, we certify that it is true that they did it. Okay, so we also discussed engagement characteristics when it comes to the environmental audits and also how environmental audits can contribute to environmental accounting. Right, so let's have a 5 minutes break. Okay, then when we come back, we will start looking at external analysis. So please grab water, stretch in this 5 minutes, and let's continue at 10:35. All right, thank you. All right, so let's move on and start looking at serious business. So let's start off by looking at external analysis, right? You guys will attest to the fact that companies do not operate by themselves, right? It's not like, oh, let's do this alone. We are going to strive. We are going to survive. No, there are some externalities that affect companies. And as business leaders, or as we want to aspire to be business leaders, we have to learn to know the models that are available to help us identify these external factors. And that's why we have strategic planning, external analysis. That will help us know the external factors that are available and the ones that will affect the company. I always tell people that it's not just about identifying the external factors, right? Because some external factors will be there, but they might not necessarily affect the company that we are operating. So we have to know the ones that are there and concentrate on the ones that are affecting the company or our company, right? Great. So here we are looking at the whole macro or general macroeconomic environment and how it is affecting companies. So here, the environmental analysis will help us assess our strategic position, right? So before we make any strategic choices, we are supposed to know how well we are faring with respect to our external analysis. The purpose of the analysis to assess the environment, to analyze the position of an entity in relation to its environment, and to judge how the entity's strategies should be developed to either take advantage of the opportunities that are available to them or deal with potential threats. Okay, so you realize that when it comes to the environment, we have opportunities and threats. So environmental analysis will help us look at the ones that are opportunities and the ones that are threats. So we have two models generally when it comes to the environmental analysis. We have the pestle model. Guys, like this is one of the cheapest model that we have in case study. So please know some of these models because if the examiner brings us one of these models, we are getting everything. If it's 10 marks, we should get 10 over 10 because it's too flexible, it's too open for you to express yourself that this is what I think is a political factor. This is what I think is an economic factor. Okay, right. So when it comes to the personal model, we are saying that we have about 6 frameworks for analyzing the things that affect a particular company. So we have the political framework, the political environment, economic environment. We have the social cultural environment, the technological environment, the legal environment, and lastly, the ecological environment. So with the political environment, you're talking about the political influences on a particular company. And I told my students that usually a factor can be political, but can also be economic. Because who brings on taxes? It's the government, right? It's a political party that, brings on board taxes. Something like e-levy is a political issue, but it's an economic issue as well. When you see anything like that inside, write it for both of the factors. So with personal analysis, your sheet, right? Political factors, you underline, you leave some space. Economic factors, you underline, you do it for all the factors. Now, this is not the time that you are going to look for them. You should have read the case. You should have listened to the case over and over again that you know that there is this line here that talks about the government doing something. Let me just go and bring it here. So you just write, you open the case, copy. Oh. So just know what is an economic factor, what is a political factor, what is a social cultural factor, and just come and write it. Some of them you can get more points there. Write everything that you think is a political factor. Write it. If you are getting 10 factors as economical factors, write it. If you are getting just 2, just write it and move on, right? Don't cry that, oh, I'm getting 10 here, I'm getting 2 here. No, write it for them. So that's political factor. Political influences on businesses, right? And usually we talk about political stability, we talk about, an indication that the government will nationalize the private companies that are there, whether there are wars and civil unrest, whether there are threat of terrorist attacks and all of these are political factors. We have economic factors, which is my favorite. Here, guys, write everything economical that you see in the case. Write it for the examiner whether it's GDP, whether it's GDP per capita, whether it's growth in the economy, interest rates, foreign exchange, unemployment, taxes, free trade, everything economical. Please write it. Then we have social culture. Here we are talking about demographic and cultural influences in the company we are operating in or at the society that we are operating in. So we are talking about values of the society, values of the customers, their attitudes, their beliefs, their demographic. So the affluent in the community, the people who are rich, the people who are not rich, anything, right? Last year, they brought a case discussing a lot of things. You realize that it was a real estate company or a real estate case. Oh, yes. The fact that some people had the money to buy land or buy buildings at cantonment. You know that if you don't have money, you can't do that. And that is a social cultural factor if the examiner had asked those candidates to do personal analysis. religion, you know, proportions of different age groups in the society, right? That if the proportion that are children, proportion that are adults, proportion that are old age. I don't know if you guys heard that in Japan, even the companies there are motivating the employees to give birth because most of their populations are old people to the extent that it's like they are fading out because if all these old people die, their population will reduce. So companies are giving incentives that, oh, I'll give you $70,000 if you give birth to one child. Guys, it's happening. Oh. It is happening in Japan because of how their demographic or how their age proportion is. We also have technological factors. Here we are looking at science and technology. So whether there are any future plans when it comes to tech, whether they are doing any investment, whether they are doing any research into technology. We also have ecological influences, which is the influence on the natural environment. So are there any regulations? Are there any environmental factors that they are supposed to, consider? Are they faced with the issue of raw materials? Are the raw materials renewable? Okay. Do they have the strong research team to conduct or to have, you know, a contingency plan for their environment? Do they have an environmental management system and all of that? We also have the legal environment, which is usually linked to any of them because here we are looking at laws and regulations, and you know that laws and regulations can be under ecological, it can be under technological, it can be under sociocultural, it can be under economical, right? Good. Are there any laws? Are there any new laws? Are there any legal variations between countries? Are they doing any international trades? Are there double taxation agreements and all of that? I mean, just like any other model, PESO has some limitations. It is easier to use PESO to identify environmental influences in the past and present. Okay, because with the analysis, we are looking at what is usually in the past and what is happening now. And it doesn't really give us the opportunity to look at what is going to happen in the future. And also, it just gives us a framework for identification of these environmental influences. It doesn't give us any quantitative tool to measure which of the factor has the should we pay more attention to and all of that. Because of this, management are usually subjective when it comes to the factor to pay more attention to. We also have Porter's diamond, and under the external analysis. Okay, so with Porter's diamond, we are saying that here we are talking about the competitive advantage that a particular company has taken into consideration a company of that same nature and size in another country. So, Inogboatin Company Limited is in Ghana. Mamiefie Company Limited is in Nigeria. They have the same size, the same competencies, everything. What is making Enoch different from Mamiefia? That is what we are talking about. Sometimes it is the environment or the country that is in that is giving them that upper hand over the other country. Porter's diamond. So companies have certain things they are known for. I always say that when we mention Cuba, what comes to mind? Doctors, right? When we mention Dubai, what comes to mind? Tourism. When we mention US, Japan, you might think about IT and communication products. When you mention Switzerland, US, you might think about pharmaceuticals. UK is best known for their investment banking, right? That's where we have the Goldman Sachs, the McKinsey, and all, right? Now, I asked us, in fact, it was a very interesting question. What competitive advantage do we have as a country? I mean, Ghana. Do we have any competitive advantage? In fact, today is not the day for us to debate. But yes, that is that is it for the national competitive advantage that Michael Porter discussed. So Porter says that traditional economic theory states that a country inherits a comparative advantage over other countries in particular industries because of the natural resources that they enjoy. So let's say because Ghana has gold, because we have petroleum, we tend to enjoy some benefits. Natural resources include not only land and mineral deposits, but also the labor and the size of population that we have as a company. So basically, we have four elements when it comes to the Porter's diamond, and the elements are favorable factor conditions, related and supporting industries, demand conditions in the home market, and also firm strategy, structure, and rivalry. Guys, you realize that the examiner has added two additional concepts to Porter's diamond, so now they are not four, they are six. So the examiner introduced the role of government in creating competitive advantage, and lastly, what we call chance. So with favorable factor conditions, we are talking about the economic factors of productions that the company or the country has, right? So do they have land available? Do they have the labor? Some people have land, they don't have labor. Some people have capital, they don't have raw materials. Some countries, right? And Porter further broke these favorable factor conditions into two. That is the basic factors and the advanced factors. Guys, I am hoping that this is not new to you. So with the basic factors, we are talking about the factors of production that is available to the company naturally. We didn't do anything to get it. Ghanaians didn't do anything to get the petroleum that we have. We were just fortunate to come and settle at this part of the world. So they are natural, right? It can be land, it can be fresh water. You know that apples are not grown in Ghana. We can't grow apples in Ghana because of our climate conditions, right? Recently, I heard a story, I think from TV3, that someone has been successful in planting apple in Ghana. But when in quote, the research institute, conducted their research, they realized that it's not really the apple that we know. Because we are not fortunate to have that, we can't boast of that basic factor, right? Great. We also have advanced factors. These are created and developed over time. Like these are not something that we get as a country because of where we have gone to settle. So it can be labor, it can be skills, it can be technological resources and infrastructure. Like infrastructure of a country is not natural. You guys are aware of how Dubai was. You can search You can search online how Dubai was before now. It used to be a desert, okay? But now they have cleared some of the sea. They are creating opportunities to build on the things that ordinarily they wouldn't have gotten, right? Now they have space to build. And that's why they build tall buildings, right? And these advanced factors will force countries to do things that they don't have because they can't complain that they can't just fold their arms and sit down and say that we don't have this, so we won't do anything. Most of the business principles that we know are from Japan because of their inability to get certain things, right? The just in time principle that we all know, the just in time production that we all know is from Japan. And that is because they don't have a lot of land to build more warehouses to accommodate the products that they produced. And that's how come they created the just-in-time principle. There are other things that other people have done because they don't have it. They don't have it naturally, so they have created it. You get it? Great. So that is it. That's the first principle, favorable factor conditions. Now we also have related and supporting industries. That as an industry, you get to be competitive with your national or other countries' counterparts if you have strong supporting industries. So a country's industry is made more competitive compared to other countries when there is strong competition and innovation in related and supporting industries. So you know that, I mean, by now you should know that competition will reduce profit. Competition might even reduce the sales prices of products because if the industry is competitive, no one can charge higher prices. If the industry is innovative, no one can charge higher prices. Because of that, if the supporting industry is competitive, it is vibrant, okay, we might even get things cheaper than we would have if there were no competition there. Because now no one is having monopoly. So no one has the right to charge. If you charge high prices, we will switch and go and buy from your competitor because they are equally doing same thing, equally giving us the quality that you are giving us. So we will switch and go and get it. So if we get products at that cheaper prices, we can go international and go and sell lesser than our international competitors or counterparts will be selling it. We also have demand conditions in the home market. So this principle is also saying that if Ghanaians ourselves we demand the product, that will keep the manufacturer at their toes, at their feet, to the extent that they will be innovative. Imagine the industry that the company we are talking about is innovative and is creative. Because of that, we demand that good products are sold to us as Ghanaians. Now, the quality at which the products are going to be offered to us as Ghanaians will be extended to the international market. I mean, it's these same products that they are going to sell. And because we want quality, because we are making sure that the company produces at the quality standard that we expect, when these products go international, it is going to be of quality. Imagine we don't care, we don't even buy the products. Look at tanker vehicles. The demand condition in the home market is low. Because of that, they are not really going to succeed when they go international. But imagine that Kantanka was doing well in Ghana, that we were keeping them on their toes. We were buying them, we were trying the cars. Then we tell them that, oh, can you do the seat leather? Okay. So the next cars that they will bring on board, they'll try and make it leather. Oh, can you do this? Can you do this? I mean, all these feedbacks will shape the product. That will make the products better in the international market. Okay, great. And lastly, we have the strategy that the particular firm, I mean, the firm itself is employing, right? The strategy that they have, the structure, and also the rivalry in the industry that the company is operating. Now, as I mentioned, the examiner has added two elements to the how do you call it? The Porter's diamond. So we have the role of government in creating competitive advantage. I mean, this was already there as just something that we were supposed to know, right? But now it has been added. So if the examiner asks us to state the diamond principles or the Porter's diamond, to be at a safer side, you can state the four and you can write that, oh, these are two additional, factors that companies or that the Porter's diamond also considers, right? Okay. And trust me, I mean, there's no way the examiner is not going to bring something new. There's definitely going to be a change. I mean, one of the changes that has happened, one of them is going to feature. So let's take note. So government can help create suitable conditions for national competitive advantage in such a way that they can create an education and training system that develops appropriate labor skills and knowledge. Remember that when we're talking about the advanced factor conditions, we said that those are created and developed. So the labor, the employees, the workforce of the country can be developed by the government, especially when they provide key educational and training opportunities. They can also help companies to raise their performance levels by enforcing strict product standards. You know that if there is a standard by the government, especially if these standards are adopted from an international standardization organization, we realize that the companies in Ghana will be producing at that standard, that required standard, to the extent that when they go international, the products are going to survive because the products were manufactured according to international practices. They can also create early demand for new and advanced products by purchasing the products themselves. We spoke about demand in the home market. You guys will bear with me that when businesses are starting, right, it is very difficult to get customers. Because how are you convincing me that I should switch from what I'm buying already to come and buy your product? So one thing that government can do is that, I mean, for the first set of products, the government can buy it from the company. And if you say the government is buying it, who is it going to? The same customers, right? Let's say they will buy it, it will come to us. We will take it and say, oh no, these products are actually nice, right? Let me buy it myself. So this time, not the government that's going to buy it for you. It is you that is going to buy it yourself. Okay. Now, the other one is chance. Guys, I don't know why we added this, but I mean, the examiner says we should add it. So the element of chance is the set element in the model. And it simply means that national competition advantage or a loss of competitive advantage may arise by chance. Chance like national disaster, like war, like a major scientific breakthrough occurring in a particular country, and so on. So imagine Ghana was the one that was able to come up with the COVID-19 vaccine. Oh my God. Now we would have gotten more money, right? So it would just be by chance that we were the country that got the breakthrough. Look at Ukraine now. Look at Israel and Palestine now. Look at Russia now. They are war-torn countries. And, regardless of the amenities, the infrastructures that they had, these wars had brought them down. And it wasn't their fault. It was just chance, right? Great. We also have the criticisms of the Porter's diamond. Let's look at it. We also went on to discuss competitive forces. So this is also part of our external analysis. We trying to look at how competitive we are with respect to other entities in the same industry. We discuss industries and sectors. We look at the generic types of industries that we have: fragmented, emerging, mature, declining, and global industry. We discuss the aspect of convergence, where two or more industries become one, depending on demand-led or a supply-led factor. We also went on to discuss competition analysis, where we spoke about the Porter's five forces model. That's also a very important, a very key, you know, principle that we have to look at. So Michael Porter is a very famous person when it comes to strategic management. Michael Porter, Johnson Schools and Worthington, and the other guys, right? So we discussed the aspect of profitability and competition, right? To the extent that if Enam has set up a wachi joint in my area, and all of us we have been going to buy wachi from Enam, we know that Enam's wachi is nice. Now, because Richmond is aware of this, that hey, right now that Enam started their business, she's going to buy a Benz. Wow. It's two things. Is either Enam has gone for money rituals or is doing money laundering, but she's just taking the wachi to, wash it, right? Or really, Enam is getting money from her wachi joint. Now, Richmond was says then look at, I have to also sell wachi. Ebenezer will think about it. Hey, I have to sell wachi. Eric will also want to sell wachi. Victoria will also want to sell wachi. So competition will come up, especially if people perceive profitability in a particular company. It might not even be profitability, sort of, right? It might not be that you are making profit, oh, but they will
Oh yeah.
perceive that
Pastor, we
you're
have to
making
say
profit.
moto. We have to
Who's
Pastor,
this?
Pastor.
Can you guys please mute for us? So they will just perceive that you are making profit, and they will just come and pick some. So as a company, you just don't have to think about competitive advantage. What you have to think about is sustainable competitive advantage. Now, we went on to discuss the five forces. So with the five forces, we have threats from potential entrants. We have threats from substitute products or services. We have bargaining power of suppliers, bargaining for power of customers, and also competitive rivalry within the industry that we operate in. So we have two threats, two bargaining powers, and one competitive rivalry. Right. So with the first one, and please, when you're talking about competition, think about a competitive environment, right? That is either easy for people to come in or it is not easy for people to come in. That is the threat from potential entrants. So we have an existing industry. We just have five people in the market. Now, is it easy for people to come and enjoy the profits that we are enjoying? If it is a wache selling, is it easy for someone to also start selling wache? Or it's not easy? And that's what brings up barriers to entry. So the barriers can be high or can be low. If it is high, it is an advantage to the companies who are already in the market. But if it's low, it is no, it's a disadvantage to them. There are several factors that will help create high barrier of entries. Economies of scale, capital investment requirements, time to become established, switching costs, government legislation. Let me just take one and explain it to us. Now, let me just take the obvious one, which is economies of scale. Since Enam started selling the wachi, she has relationship with Amalia, who is in the market that sells the beans and the rice. She has relationship with the gentleman that sells the wache leaves. She has relationship with the person that is going to give her the pack and all of that, right? Because of that, she has been able to negotiate low prices, especially because she has been buying in bulk with these people. Now, Boatin also wants to do the same thing, but he doesn't have the relationship that Enam has. So when he tries coming into the market, Enam will do something to make him go away. What will she do? she will further reduce the prices that she's charging for her watch, right? To the extent that even the production cost of Enoch will not even cover. So, since human beings are rational, especially when they think that the watch is watch, like watch, all of them are nice, they'll go in for the one that is less expensive, and that will push Enoch out of the market. So, there we can say that there is high barrier of entry. But if Enam do not have any economies of scale, it means that they will all come, sell at the same prices, and the entry to market will be an easy thing to do. We have threat from substitute products. It's the same as someone coming in, to the extent that if I am not buying product A, I can go and buy product B. If that chance is there, if that opportunity is there, we say that competition will be high. People will just be coming into competition, right? Because I'll just come and produce something that's similar to what you are doing, so that if the customer do not buy yours, they'll come and buy mine. We have bargaining power of suppliers. If suppliers have high bargaining power, it means that they will give you the raw materials that you're going to use to produce, right? Sorry, trying to mute someone. So since they have bargaining power, they are coming to sell to you. So they will always bargain for high prices. And with that, your profitability is going to reduce, right? But if they do not have that huge bargaining powers, they can't bid for high prices. So you have advantage of them or over them, and you know buy their products at a lesser price. So we learn about some of the things that will make or that will bring about high bargaining power or low bargaining power. So when there are only a small number of suppliers in the market, obviously the suppliers will be pompous, right? Because if you like go, then the other person, I'm the only one selling this in Accra. If you're in Accra, you come and buy from me. Because if you go and buy from the other person in Takrade, you transport it. That will be your own wahala. So you come and buy from me. And since you're coming to buy from me, I'll charge 2 cedis instead of 1 cedi 50%. When there are no substitutes for the product, whatever you are buying from me, you can't get it anywhere. So I become powerful as a supplier, right? When the products of a supplier are differentiated and to the extent that you need them. So they are different. The supplier's products are different from the other products. You might have to go and buy them. And also, if the product is very vital to the end product of the company, that is it for bargaining power of suppliers. We also have bargaining powers of customers. What will make a customer powerful when it comes to bargaining? When the volume of their purchases is high. It's high. You are selling about 60%, 70%, 80% of your finished products to one customer. They will have high bargaining power. They will tell you to reduce the price. And you might not have any other option than to reduce it because you know that if they don't buy it, you might not get a buyer. You get it? So we have other things that will give a particular customer or some customers bargaining powers. We also have competitive rivalry, where we are looking at whether there are many competitors, the growth rate in the industry, and if the products we are selling is the same as what competitors are selling. So these are the 5 forces model. We also went on to look at the life cycle model, where one key aspect that we discussed is that not all products will go through this classical life cycle model. There are some products that will just die at the introductory stage.
But
There are some that will move from introductory
Prof said Obin and Richmond.
that will move from introductory straight to maturity and decline. So it will depend. But usually, or a typical life cycle of a product will move from introductory to growth to maturity and to decline. So let's know what these are about. Let's know the kind of cost that we incur at each of these levels that is here. Let's know the benefits of the life cycle costing or the life cycle model. We also went on to discuss timing of the market, where we discussed first mover advantage and second mover advantage. The first movers are, they are risk takers, okay? So some entrepreneurial companies might look for opportunities to enter a new market during the introductory phase of the life cycle model in the expectation that the product will become successful and the company will win a large market share, because if they go in and the product is successful, they'll get the market share, right? They'll get the market. And that will deny second movers the chance to get more market share. So the second movers will come in after the first mover has gone in and is successful. The second movers are not really risk takers, so they are cautious that let's let someone go so that if they are successful, we also go into the market. Okay. So we also went on to discuss other approaches to external analysis. This is also a new area we have to look at. So we discussed scenario plans, we discussed strategic group analysis, we discussed technological advancement. So these are new areas. Please let's look at it, because as I said, the examiner will definitely bring something on the new areas that they introduced. Now, let's talk about the BCG matrix, which is also known as, or which is called the Boston Consulting Group matrix. So there are two dimensions when it comes to the Boston Consulting Group matrix, and that dimension give us 4 quadrants, which are the question mark, the dog, the cash cow, and the star. We also look at the weaknesses in this Boston Consulting Group matrix. So these guys are saying that if you have, let's say, branches or strategic business units, know which one that is worthy of spending monies on. You don't necessarily have to allocate funds to any of them. Know the ones that need funds and the ones that okay, so Garba is asking if I'll share the notes after the class. Well, okay. Please contact me when you finish so that I send it to you, because my students already have these notes. I'm just going through what we have already done. But you can contact me after the class so that I will give it to you. Okay, so as I was saying, you have to know which branch to concentrate when it comes to allocation of funds. And that is what the BCG matrix is about. So here we are looking at the market share and also the other quadrant, which is known as the growth rate. So we have 2 dimensions, the growth, that's the market growth, and also the market share. Please take note that in the Boston Consulting Group matrix, market share is measured as annual sales for the product as a percentage of the ratio of the annual sales of the keynote here is the biggest competitor in the market. Ideally, market share is your sales over the sales of the total market. But in the BCG matrix, we are taking the sales of the biggest competitor as the denominator. That doesn't mean that if the examiner didn't give you anything like that, you don't use the annual market share. If the examiner didn't give you the annual sales of the biggest competitor, please use the annual sales for the entire market. So we have the question mark, we have the dog, we have the cash cow, and also the star. So the cash cow and the stars are market leaders, right? Just that the star has high market growth and also high market share. They are all, they are all market leaders. But the cash cow has a high market share, but there's no opportunity for the cash cow to grow in the market that they are in. So they'll be having a lot of cash, which can be available to either the dog and the star. Because since the star is a star, we need to maintain the star, right? Look at these celebrities and how they spend. Just like that, the star companies should be maintained, right? The dogs are companies that might be withdrawn from the market either immediately or we will do it eventually. Now, the question marks, they also have prospects when it comes to growth, okay? So they have low market share, but their prospect for growth is high. So the money of the cash cow can also be distributed to the question mark for the question mark to become a star. We have weaknesses when it comes to the Boston Consulting Group matrix, and let me just talk about it. So the rate that we use in the model is obviously arbitrary. We don't really have what is high, what is low. Like why do we say what do we say? What market share can we say is high? Is it 2, 3, 4, 5, or 6? It is about we don't really have a standardized market share or standardized market growth that we can use. So it is not so useful for analyzing the entire market. As we discussed, it is just for the assessment of the performance of SBUs and branches. So you can't use it for the entire market, right? So it's not only market share and market growth that will influence companies, right? There are other things like cost base, the brand. Sometimes you're even looking at the brand, just the brand, okay, and the strength of competition in the market. There are other factors that will help us, okay, and because we think that the dog will have a low market share and a low potential for market growth, we will just withdraw it. No, there are other things that we have to consider that are not part of the Boston Consulting Group. Okay. Then we also have the SWOT analysis, as the name suggests. We'll be looking at the strength, the weaknesses, the opportunities, and the threats. This is also a model that we're supposed to know so that if the examiner asks us to do a SWOT, we draw a cross, right? Cross on the sheet. One quadrant will be the strength, another will be the weaknesses, your down will be the opportunities and threats, where we will find strengths that are happening in the company under review, where we will look at the weaknesses, the opportunities, and the threats that are available. Okay, so let's move on and look at strategic planning, internal analysis. Let's look at internal analysis. Right, so we said that since the companies are not operating in isolation of the environment, after analyzing our performance, our position in the environment, we have to also look at our strategic capability as a company. We have to look at our strategic capability. What are our strengths? What are our weaknesses as a company? And that's what, strategic planning, internal analysis is about. So here we started by looking at strategic capability. How capable, okay? We want to know your ability to employ and also exploit the resources that are available to you as a company. The resources might be available, but you efficiently utilizing it, okay? And we realize that, if you efficiently and effectively utilize your available resources that will give you competitive advantage, and this competitive advantage will give you the strategic capability. We also looked at resource audit, where we are initially assessing the resources that a particular entity has. What are the resources that they have? What is the required amount of the resources that they are supposed to have? And what are they having currently? What are the steps that they are taking, to reach what they are supposed to have? What are some of the resources that we can provide audit for? Human resources. So here we are looking at the employees that the company are having now, and if they are supposed to have more employees, right? So we have management, raw materials, non-current assets, intangible assets, and also financial assets. One way of evaluating resources is what we call the VIRO framework. So with the VIRO framework, we are looking at the value, the immutability, the rarity, and also the organization of the resources that the company has. So with the value, we're asking ourselves if the resource provide competitive advantage to the company. With immutability, is it very easy for companies or for competitors to just look at what we are doing and copy? For rarity, is the resources that we are having rare, or we are the only ones that have it? Is it unique to us, or it is similar to everyone? And lastly, is the entity organized to exploit the resources to their best advantage? That is what the organization is. So, viral is something we are also supposed to know, the viral framework. So, remember, we have the value, immutability, rarity, and also organizations. Any questions? Any questions? All right. So we also went on to discuss the aspect of customer needs. We realized that for you to have, strategic capability, you have to make sure that the product that you are producing as a company is what the customer needs. And we looked at the reasons why a customer will choose a product over the other product. So we spoke about the price, the quality, the better design features, availability, convenience, and also the influence of advertising. We went on to discuss the 4 Ps, where we discuss product, price, place, and promotion. We also discuss critical success factors for products and services. We discussed CSFs and KPIs. We also discussed the 6-step approach to achieving competitive advantage using critical success factors. So we had 6 steps. The first one was to identify the success factors that are critical for profitability. You identify what is necessary to achieve a superior performance in the CSF. You as the entity should also develop the level of critical competence so that it acquires the ability to gain a competitive advantage. You identify appropriate key performance indicators for each critical competence. You give emphasis when it comes to developing critical competences for each aspect of performance. And lastly, you monitor the firm's achievement of its KPIs and monitor comparative performance of competitors. We also went on to discuss benchmarking. So with benchmarking, we are saying that who is the best that I can copy? That is all. Who is the best? Who is doing things right that I can copy, whether blindly or not, to my operations? That is benchmarking. So we had about 4 methods when it comes to benchmarking. So we have the internal benchmarking, where internal or units or departments will, compare their performance with each other so that they will try and adopt what someone is doing to also help them to do well. We also have operational benchmarking, we have competitive benchmarking, and also customer benchmarking. So with the customer benchmarking, we are looking at the products or the things that the customer expect that we provide to them and what we are actually providing to them. We also spoke about the methods for competitor benchmarking, where we talk about ratio analysis and all of those. We also went on to discuss the famous value chain analysis according to Michael DePorter. And wait, value chain also, the examiner has added something here, so please take note of it. So with value chain, we are looking at the value that is added to a particular product at every point in time when it comes to the production process of the company. And we have two types. We have the primary value chain and the secondary value chain. So with the primary value chain, we have things that relate to raw material storage, material handling, transportation. Those are called the inbound logistics. Inbound because they are coming in the company. We also have the aspects that converts raw materials like using the machines, cleaning the machines and all of that. That is operations. We have outbound logistics that will also look at the finished products, how we are going to store them, how we are going to distribute them. We also have marketing and sales. We lastly have service that usually look at after sales services. Okay. Any questions? We also have the secondary value chain analysis that also look at procurement, technology development, human resource management, and lastly, corporate infrastructure. These are things that I expect that we know by this time. Okay, so this is the extension of the value chain analysis where the examiner talks about upstream and also the downstream. That's the only thing that the examiner added. So please look at it and look at it very well in case the examiner wants us to look at it or discuss it. We also discuss methods that value can be added and also value creation and strategic management. Customer relationship management has been, taken off the syllabus. So it was something that we skipped, even though those in my class were tests that I quickly ran through them before we moved on. Okay, let's talk about resources and competences. Remember, we have already spoken about resource audit. So here we are talking about the resources, which are assets, processes, the skills, or the knowledge that a particular company has and control. So the resources can be human resource, physical resource, financial resource, and also intellectual resource. We discussed the issue of threshold resources and unique resources. As the name suggests, threshold resources are the resources that we need in order to enter into the market. That is the minimum requirement. Now, there is also another leg which is known as the unique resources. As the name suggests, they are unique. They are not just like any resources. So they are not easy to imitate. They are not, really, they are rare too. That's the thing. They are very rare. Okay. And we also have the aspect of competences where we have threshold competences and core competences. So it follows the same concept as the unique and the threshold resources. The threshold competences will be the minimum, and also the core competencies will be the unique one. We discussed competitive advantage and capabilities. We discussed dynamic capabilities. We discussed ways that companies can use to achieve efficiency. So we spoke about economies of scale and economies of scope. We also know or learn how to assess, strength analysis, SWOT analysis by looking at the strengths and weaknesses of a company. Right? These are things that I expect us to know. That's why I'm not taking my time here. So the examiner also added some few things here. The aspect of blue sky thinking and gap analysis. I mean, gap analysis was already there, but the examiner introduced blue sky thinking, and it's just like a brainstorming activity where a group of individuals they come together and come up with ideas for the future and discuss them. Okay, so they will come. What are the things that are happening or that are usually to happen in the future? So they look at it and they talk about it. They also compute gap analysis where they look at where they are now and ideally where they are supposed to be at. The SAF is already part of our syllabus. The sustainability, acceptability, and also feasibility framework. We learn all of these and also how to compare options and stuff. So basically, these are the things that the examiner expects us to know under internal analysis. I mean, today we are not going to look at functional strategies because it is an area I expect us to, just brush through because the examiner do not really bring a lot of questions there. So please, when you get time, please go through functional analysis where you have to look at the information system IT function. You look at the human resource function, the production function, the research and development function. I think e-business is also there. So please, have time and go through all of this. I mean, let's give ourselves another break. And when we come back, we will discuss approaches to strategic choice and strategic business plans. Okay. So let's come back this time in 10 minutes time, right? So that we have more stretch, so that we don't this doesn't get boring. Okay. So let's resume exactly 11:45. Exactly 11:45. Okay, recover. All right, so let's quickly look at chapter 7, which looks at the approaches to the choices, the strategic choices that are available to companies, and the one that we will select, okay, as well as business plans. So here we are going to start off by looking at strategy change. So with change, we were able to establish that, guys, as we are all aware, it's very difficult for humans to change, right? I mean, we love it when we are in our comfort zone. We love it if we are used to something. Okay, so whenever the company wants to change their business process, to change their way of doing things, they need to make sure that this change is managed well. Okay. Now, with respect to the nature of change, change can be planned or unplanned. Change can be planned or unplanned. With planned change, the company is intentional about it. The company will be proactive that we think that in the next 5 years, we'll be using AI. So let's start right now. Plan change. When the IFRS or ISSB released the IFRS S1 and S2, I think ICAG brought a directive that Ghana will, start looking at it within the next 3 years, right? But you know that these standards okay, so you know that these companies can start adopting these IFRS S1 and S2 right now, so that by the time it will be a requirement, they would have been used to it. So that would be called a planned change. So planned change, they are usually deliberate, okay, and usually the client would have seen an opportunity that they want to exploit, okay. They would have seen an opportunity that they would want to exploit. With unplanned change to, like, there's no intentions for us to make the change, we are usually reacting to a particular
Lydia.
event. That's okay. Victoria.
Yes, please. Yeah, I don't know. I can't see your screen again. I know that it's from my end though.
Okay, I think because I went off. Okay, sure. Thank you very much.
You're welcome.
So with unplanned change, like, it is reactive. Take something like COVID-19. We didn't see it coming. Okay. So companies who were always doing face to face had to do virtual, right? Most of the companies had to use Zooms, had to use Google Meet and all of those, work from home and things. You get it? Now, it was COVID-19 that forced these entities to do the things that they were doing. They didn't plan to do it. And that is unplanned change. So change can also be incremental or transformational. Incremental in the sense that even though we want to see ourselves in the next 5 years, let's say, start we want to start using the color green in the next 5 years. We will start small, small until we get there. Okay, we want to change our uniform. We can do it in phases that, oh, just like ICA is doing. I hope you guys are aware. Now they want to move to the computer-based assessment. And they want to start with um your friend is saying level one. Okay. So this is an incremental change. They know that when they start the change just like that, it will be very difficult for them. So they want to, we call it piloting, right? They want to pilot it at a particular stage. Then, guys, please give me a minute. Sure. Okay, so guys, forgive me. So I was saying the change can be incremental or it can be transformational. So what ICA is doing, it is an incremental change. They want to do it small, small, little by little, piece by piece. They want to do it in phases, right? So that at least we will be used to the changes as and when it goes on. Transformational change is not like that. That is not easily adaptable because we are just doing the change once and for all. Imagine ICA saying that this setting, all of us, we are doing computer-based assessment. That would be chaos. So we get it. Mhm. So and usually comes a major reorganization or restructuring of the systems of the company. And it really have an impact on the company to the extent that sometimes you might have to lay off some people, right? Great. And one key important thing about transformational change is that usually we need to have change managers on board. Change can also be a one-off event or a continuing process thing. We also discuss triggers for change. What will require that we change something that we do in the business? We realize that it can be coming from inside the company or it can be outside the company. So we spoke about the external triggers for change and internal triggers for change. With the external triggers of change, we realize that it's the same as the personal analysis that we discussed. So the political reason, economical, social, cultural, technological, ecological, and legal reasons. But with the internal reasons, sometimes when we appoint new key management personnel, they come with their own rule. They realize that Victoria will say that when I was at UCC, this is how we are doing it. So KNUST, now your CGPA will be, your A will be 80. It won't be 75 or 70. You get it? Because she has been appointed, let's say, as the vice chancellor or whatever, she will bring on board her policies that might change the way that we used to do things. And that is it. So I have here new king, new rules. When the MD is changed, the MD might introduce things that will require a change when there is acquisition and measures, right? Imagine AT, right? Airtel and Tigo merging, there are definitely going to be some changes, right? Because let's say with respect to payroll, we might be going by how Tigo used to do it. What happened to us in Airtel? It will be a new thing to us, right? So however it's going to be, we are going to see some new things. The measures and the disbursement or divestment and also reorganization, downsizing and rationalization. So we also looked at the consequences of change and what change management is about. We also looked at the attitudes of change. We realized that sometimes people will protest or oppose the change that is happening. Okay, so we look at some of the reasons why people will oppose it, right? So we realized that some of these reasons are related to the job. Others are related to personal and also fears. And lastly, these reasons are related to social issues. With issues or reasons that relate to the job, they are the employees are scared that or they might believe that the change will put their job at risk and then make them redundant. And usually that is what happens, right? That as the change is coming, imagine you're a typewritist or you just know how to use a typewriter and we are bringing a computer, you're not going to survive. Because of that, as a typical employee, you might want to oppose it. They might also fear that working conditions might change. They might believe that the existing skills will no longer be relevant. So the personal reasons, social reasons are also there. We also discussed change and organizational culture. We realized that some people, some firms, when you go there now, you know that even if I don't have a change mindset, I have to have one because of the things that I have seen already. Okay. there are some companies that change is always happening. Because of that, if you are working there, you have to be used to change happening, right? But what about, I'm not downplaying any company, but what about our public institutions, which we are used to a lot of things, right? If there is change, we might have to oppose it because we are
Uh,
not really
uh,
used to change. You get it?
okay.
Great. So that is it for change in organizational culture.
Mm,
So Roosevelt Moscanta suggested that some companies are known as change adept
yeah,
organization.
you know,
It is because of,
also,
who is this?
yeah. Uh,
Okay, so some companies are change adept because they have an imagination to innovate, because they have professionalism to perform, and also they are open to collaborate with other entities, right? So these are the three key attributes of a change adept organization, according to Roosevelt Moscanta. So please take note. So we also looked at how to manage strategic change. We also discussed the levels of change, that is the requirements for a successful change. We looked at the role of management when it comes to change, and also the skills that management require to have when they are leading change. So we discussed some models for managing change. We started off by looking at the Lewin force field analysis. So Kurt Lewin was the one that brought into place this force field analysis, and it describes the forces that come into conflict over planned changes. So this guy suggested that there are two forces. We have the driving forces and the restraining forces. The driving forces will come in to come and support the change, but the restraining forces will come and resist and oppose the change that is going to happen. Any of the following factors might be a driving force or a restraining force. So the people involved in the change, they can be a driving force or a restraining force, depending on how exposed they are to the change, whether you have made them understand the change and all of that, the habits and customs of the individual, their attitudes, the resources available to make the change. How can we start a change if we don't have the resources, right? And also the regulations that are available. So change is only possible when the driving forces for change are stronger than the restraining forces. If a lot of people are restraining you, you can't successfully implement the change. So you implement the change well if more people are supporting the change than people who are restraining or resisting it. A key task of the change manager is therefore to ensure that the strength of the driving forces is stronger than the strength of the restraining forces. Okay. What are the two ways that are supposed to be done? There are two ways that this might be done. I mean, how to strengthen the limit the restraining forces and improve on the driving forces. So you strengthen the driving forces for change, and you restrain the restraining, or you reduce the restraining forces against change. So you can do this by getting the best approach, by identifying the main restraining forces against change and considering ways of reducing their strength. So if it's because they don't really understand the change, you can sit them down and persuade them. When Kurt Lewin finished this model, he went on to implement or brought on the unfreeze change refreeze method. That when there is a prescriptive planned change, okay, when there is a prescriptive planned change, this is how we are supposed to do. So we plan the change. And since we planned it, we have to unfreeze. we have to change and refreeze. So unfreezing means that you are persuading employees to change. That we need this change. Oh, this and this and this are why we need the change. Employees should therefore be encouraged to recognize what is wrong with the current system or current situation, and management should encourage employees to feel dissatisfied with the current system. They should feel the need of the new system we want to implement. So that's unfreezing. With the movement, that's the change. That's where the actual change happens, right? With freezing, after the change has occurred, there is a tendency that we will go back to the old system. Sometimes companies will implement an IT system. After the implementation, that someone will come, Joel will come and he will say that I'm not this IT that you guys have brought. That we that are BBC, they call it BBC, born before computer. We don't really like these things. So Joel will champion. You know what? Just today, let me start. Let me write. Let me just go back to the paper. So Joel will write first day. Edward is also having the same mindset as Joel. So the next day he also go and write. You realize that by and by we will just go back to the old system that we said we were changing from. Okay, so refreezing is making sure that the employees not go back to their old ways, right? And that is it. As we discussed, sometimes you might have to have a change agent who will come and drive the change that we want. So that person will be responsible for the successful transformational change that we want to have in the company. The person might be an outside, consultant, and if that person is from outside, everyone will not think that the person is biased. Everyone will think that the person is independent, especially the employees that are going to be affected, right? And and when we take someone from outside the company, that person might have experience in managing change because that's his work as a consultant and what's not. So the change agent must explain the reasons for the change to the employees. Explain the reasons for the change to the employees. The change agent is supposed to make employees aware why there is the need for the change. Okay? Like he has to make them understand why they have to change. If there is anyone who is going to be affected, probably someone is going to be laid off. That person is supposed to, take their time to explain to the person. Some companies also even have psychological services during these times so that as you are going home, you won't think that that is the end of life, right? And also, the people who are going to use the new system, it might be that we have to give them some form of training. It is the work of this change agent to do that. And also, emphasize the benefits of the change to individuals who are being affected. So, after Lewin did this, Gemini also brought on 4 R's when it comes to change. So he also says that, we have to reframe, we restructure, we revitalize, and we renew. So these are the 4 R's per Gemini. Please look at it. Right. We also went on to discuss the soft factors and the hard factors according to McKinsey. And these are the models when it comes to the successful implementation of strategic change. Realize that there are 7 factors that contribute to the effectiveness of firms. We looked at all of these. So the hard S's are the strategy, the structure, and the system. And the soft ones are the staff, the skills, the style, and the shared values. Remember, I told you guys that we treated cultural web in another topic, right? So this is what I was talking about we treated organizational web here. We have 6 elements of the cultural web: stories, symbols, organizational structure, control systems, rituals, and routines. Okay. Let's also discuss the organizational structures that firms can adopt. Let's start off by looking at the contingency theory of organizational structure. All right, so this theory proposes that the most effective organizational structure for an entity is dependent on the circumstances that are around the entity. Okay, so the most effective one is the one that has considered the circumstances surrounding the organization. So, with the circumstances, we are talking about the size, the complexities, the current developments in the organizations, and all of those. That brought us to Burns and Stoker structures when it comes to, their approach after they gave us the mechanistic and the organic structures. So we also discussed these two structures. They are under the contingency theory. So we have the mechanistic organizational structure that is bureaucratic in nature. Power over decision making is, given to a person's position. So because Patrick Chumesi is the CEO, because he is the CEO, he has power. That's the mechanistic organization. Communication is verbal, up and down only. Do this, I've done it, say. Do this, I've done it, say. That's all. And also, job descriptions are precise. So, Patricia, you have been appointed to stamp receipt. That is all. That is all you're supposed to do in a mechanistic organization. When it comes to the organic organizations, it's not really bureaucratic. Individuals influence decision based on their knowledge and skills. Because you have qualified as a chartered accountant, regardless of your position, they give you opportunity to influence decisions, right? Here we say that it is organic. There is much more horizontal communication and free flow of information. So it's not just top to down. No, you can, communicate with your colleagues and all of that. Job descriptions are less precise. So we don't say that Abbas was appointed to come and sign checks. So that's the only thing that he can do. He can also look at other opportunities that are there in the same department or unit. We also went on to look at Mainsberg 5 building blocks for organizational configurations, where we discussed the 5 building blocks: strategic apex, operating core, middle line, support staff, and the techno structure. Okay, so please let's look at this. We also discussed the organizational configurations according to Mainsberg. So we looked at the simple structure, the machine bureaucracy, professional bureaucracy, divisionalized form, adhocracy, and also the missionary organization. Please, as I'm mentioning the thing, if you have forgotten anything, you can write it down, right? Because some of the things, if I mention them, clearly you'll be familiar with them, right? But the ones that you think you have to go back and look at it, please write it somewhere, right? So that you find your time, your own time to look at it. Let's look at Fitzgerald the moon building block model. So here, these guys are giving us a model to analyze performance of service businesses. All this while we have been talking about product or goods based businesses, right? But Fitzgerald's and Moon's model is looking at companies who are into service businesses. So these guys suggested that a performance management system in a service organization can be assessed as a combination of three building blocks. So we have the dimensions, if you remember, the standards and the rewards. So we spoke about the dimensions, we spoke about the standards, which was further categorized into own, achievable, and fair. We are saying that if you want to assess them, if you want to look at how well employees are doing, right, with respect to the standards that you have set, you have to make sure that the standards are achievable, the employees see the standards as their own, and also the standards of performance are fair to everyone. Okay, then we spoke about the results. When their targets have been met subsequently, right, how do you reward them? Okay, because they are motivated to work harder to achieve performance targets when they are rewarded for successful achievement. Okay, especially if you give them bonuses, if you give them whatever they need, that will make their life possible. And another thing is that individuals should only be held responsible for aspects of financial performance that they can control. I use the bank's branches as an example. For instance, the the head office can say that if you get any penalty, right, as a branch, it will be used in determining the performance of the branch manager. Okay, so when the branch manager is doing performance appraisal, we look at the penalties that has been paid because of the actions of his branch. Okay, now imagine that the banks and specialized deposit taking institutions require that banks keep summary financial statements in their branches, right? So imagine that when the Bank of Ghana went to do a compliance audit at this branch, the head office hadn't sent that summary financials to the branch manager yet. The BOG finds the bank. Can the bank's head office charge it to the branch manager? No, because it wasn't his fault that the summary financial statements were not in, because it is the duty of the head office to bring those summary financials, right? So this is what we call the responsibility accounting method, that individuals should only be held as responsible for aspects of financial performance that they can control. In this case, the branch manager couldn't control the summary financial statement being brought to him or her. We also discuss business plans, and sometimes the examiner might ask us to draft a business plan. Okay, so these are some of the things the examiner wants us to know: the basic structure of the business plan, the purpose of the reports, the person preparing it, the person we are preparing it to, the purpose of the report, okay, the work done to reach the conclusion, and the proposals or recommendations. Those of us having the old book, you can glance through the outline, okay, the outline of the business plan. So please write it somewhere so that when you get time, you glance through it. It wasn't really highlighted in the new syllabus, but I mean, you don't lose anything glancing through it. So please, let's do that. Okay, let's look at risk. Let's look at risk. Okay, so guys, if all of us are able to do this round down again ourselves, right? You see how we've we've been talking about the things, right? How we've been looking at it in that order. If we are able
My
to
phone
sit
just
down,
fell. Yeah, now I waiting you. The network. No SIM.
if we are able to do this ourselves, trust me, we are going to be very good at the exams. Right? Even before the case comes, we are going to be fine. All right, so let's move on and look at, risk. So we started by looking at um, performance management, not something I'm going to talk about today. We also look at the main thing, which is, the nature of risk and risk management. So we discussed what risk is and some definitions of risk that connect risk to returns. We discussed responsibilities of risk management, where we said that it is the duty of the directors of the company, the overall onus is on the directors, okay, to make sure that risk management is done well. When we say risk management, we are talking about risk identification, assessment, and controlling of risk. And also, the board have the responsibility to safeguard the assets of the company and to protect shareholders' investment so that they don't lose the value. Okay, right? So we discussed internal and external risk. Obviously, the external risks will come outside the company. Internal risks are within, and SWOT analysis is used to determine these items. We discussed the elements of risk management system, where we said that first of all, as part of the company's culture, there should be an awareness of risks in the company. How do we do that? There should be banners, the desktop of the company's organizational laptops and things. Everything should be risk. We have to be risk aware that the least thing that we do will cause the downfall of the company. There should be a system and process for identifying, assessing, and measuring risk. There should be an efficient system of communicating information about risk to the board of directors and senior management. And also, strategies and risks should be monitored to ensure that strategic objectives are being achieved within the acceptable levels of risk. Okay, so we also went on to look at how we can identify risk. Okay, and that is the first stage when it comes to risk management. What are the risks that can affect us as a business? Okay, so usually companies will have a subcommittee, in their board who will be in charge of risks. So they are called the risk committee, who will try to understand the risks that the company faces. The ones that are external and internal to the company, and how we can control and mitigate the impact of these risks on the company. We also looked at how we can assess risk, okay? And when we looked at the IP, that is the impact and the probability model, which is also known as the risk profiling or the risk mapping, where we try to look at the impact and also the probability, right? So what is the impact when the loss happen or when the event happen? And what is the probability that the particular event will happen? Okay, there are two different things. The impact will assess how the company is going to be affected when the risk occur or when the risk materializes. But the probability is the likelihood of the event happening, right? So this is a model that we're also supposed to look at. So we have high impact, low impact. low probability, high probability, when the impact is low and the probability is low. So if the thing happens, we're not really going to feel it. And it is not really likely that it will happen. Then you review periodically. You don't trash it that, oh, this is low and the probability is low, the impact is low. Why should I look at it? No, because the probability might grow from being low to high, or the impact might grow from being low to high. That is why you have to review it periodically. When the probability is low, but if the thing happens, the impact is huge, then we can consider measures like insurance, so that even though there is low probability that a thing will happen, if it happens, we have insurance cover. If the probability is high but the impact is low, then we will consider the need for action to control the event. And if the probability is high and the impact is high, we have to take immediate action. The immediate action can be insurance or any other thing that will help us control the risk. How do we measure risk? We also looked at it, where even if the risk item is non-financial, we can assign a quantitative figure to the non-financial item so that it will help us to measure the risk. We also discussed the methods of managing or mitigating risk. We said that we have different approaches when it comes to controlling risk. We discussed diversification, risk transfer, risk sharing, and also hedging. With diversification, we said that you are spreading your wings. Sorry, you are moving to other industries, other places where you wouldn't really be shocked when a particular event happens. We learn about when it is appropriate for diversification to be used. When management have the skills and experience to manage the portfolio, like they have the skills to manage a lot of things, then we can say that we can do that. Diversification is less appropriate if it takes the company into an unrelated business activities, especially when you are moving into an unrelated environment where you don't know anything about it, you don't know the industry, you don't know the culture, right? Good. And also, risk is not reduced significantly by diversifying into different activities where the risks are similar. What is the essence of you diversifying if the risks are similar? So you have to make sure that the risk profile is different, right? There has to be a negative correlation between the two industries you are going to, invest, in the sense that if one is going down, the other will be going high to complement each other. We can also transfer risks by passing the risk to another person. A typical example is insurance. We can share risks by forming joint ventures, strategic alliances, and all of that. I mentioned co-insurances and reinsurances. That's a very good example for our insurance companies. And lastly, we have hedging. We spoke about risk avoidance and risk retention. We spoke about risk appetite and risk retention. We also discussed the fact that the risk appetite is set by the board. We discussed the TARA framework, which is also a framework for controlling risk. So we have risk transfer, avoiding risks, reducing risks, and also accepting risks. Sometimes it is prudent for us to accept risks, especially if the cost of fighting the risks is way higher than the benefit that we are going to get from the risk itself. You can also reduce the risks by setting or putting in place measures like internal controls, CCTV cameras, and all of that. You can also avoid risks by not venturing into a particular item at all. I always use credit risk as an example. Credit risk is the risk that if Gariba comes to buy from APS professional school or APS college, the risk that he won't pay, or he or she won't pay us the money, or he or she will default, right? That is a risk. Now, if the company decides to just run a cash basis, or a cash system where we only sell on cash, we don't sell on credit, we would have avoided the issue of credit risk, right? Because we are not going to sell it to anyone on credit that the person will come and tell us that, oh, I don't have money. If you don't have money, we are not even selling it to you out in the first place. You get it? Great. Many things we can look at here. Sure. So, risk is also done. Let's take our time and look at it. Let's move on and discuss globalization and international strategies, where we have the models for international strategies like the EPRG and the other things. Okay. All right, good. So sometimes companies want to go international, right? Especially if they think that, oh, now we have money to go and compete with the international businesses. Why don't we sell to China? Why don't we export to Japan? Why don't we sell in the Ghanaian market in the UK? You get it. So there are reasons for globalization. Please take note of it. Okay. We have four drivers: market drivers, cost drivers, government drivers, and competition drivers. So with the market drivers, the company tends to get opportunity for selling more goods or services. Okay. And to expand its business, companies may decide to sell products and services in the foreign market. So we want to expand. Like we are producing, we have the capacity to produce beyond the Ghanaian market. So let's go international. We have cost drivers that may develop their business into other countries to reduce cost. We are going to look at this very soon, but you realize that sometimes we will think that Ghana is very hard when we want to do business. I hope you guys are aware that SG, the parent company for SG, is going. I mean, the main, not, I mean, the shareholder, the major shareholder is going because they think that Ghana has not necessarily become a tough country, but now look at the dollar issue. Now it is now that the banks are making profit too. It is now, I mean, compared to previous years. But as they are even making profit, our money or our cedis is not valuable for the shareholders to feel the money we are making. Because when we make the money here, we have to convert it to USD. And if we are converting, the depreciation will take all the money away. Okay. So it's not really an important, or it's not really reasonable for them to be here. So if a company thinks that it is cost effective to do business in a different country aside Ghana, then they will move there. We also have government drivers. Companies may develop business into other countries because of initiatives taken by the domestic government. Remember that the government of Ghana was building platforms, you know, admonishing and persuading companies to come to Ghana and to come and invest in Ghana. Okay. And, you know, there are a lot of incentives for foreign companies, especially when they are coming to Ghana. So let's say Nigeria does something that, oh, any foreign company coming to Nigeria won't pay taxes for 5 years. Don't you think some Ghanaian companies will go there? They will go because of this government initiative. Lastly, we have competition drivers that companies may expand their business into other countries because of threat of foreign competition. So you want to come here. Okay, good. I also come there. You get it. You're in US, I am in Ghana. We are all operating on our own. You want to come here? Okay, me too. Let me come there. That is it. All right. So when a company wants to enter into the foreign markets, they have to consider their international strategy model and also the model for market entry. So the models for international strategies, it is also known as the management orientation, which is also known as the EPRG framework. So here we are talking about the ethnocentric, the polycentric, the regiocentric, and the geocentric. I hope by now you guys know what these frameworks are about. We also have the integration responsiveness framework
Fine.
where we discussed, you know, two aspects of the things that we will have to take into consideration if we want to go into international, right? There are two competing needs or conflicting needs. That is the need to integrate the company's value chain analysis globally, and also the need to make and sell products that respond to the needs of the local market in each individual country. So we discussed the IR method as well. Okay, we also went on to look at business strategies for responding to the competing pressures that come as a result of the IR metrics, and this was according to Bartlett and Gorsal. So here we had the international strategy, the multi-domestic or multinational strategy, the global strategy, and the transnational strategy. Please revisit it if you have forgotten what these things are about. This is an introduction to the syllabus where the examiner, is giving us the 5 stages of globalization. Guys, trust me, can mark it on the wall. This sitting, the examiner will bring something that is addition or something that they have added to the syllabus. Trust me. So let's take note of those things. So there are 5 stages when it comes to globalization. We have the market entry, we have the product specialization, we have the value chain disaggregation, the value chain re-engineering, and also the market expansion. So with the market entry, this is where we just enter into another country that we have also come, international market, right? We are also here to come and do business. Now, when we do that, we go on to the next stage, which is product specialization, where as a company, we will transfer our full production processes to a low cost location in another country. So let's say Benin is very cheap when it comes to the production of sobolo. What we do is that we will pick up all, let's say we're in Ghana, right? We move to Nigeria. Now, when we move to Nigeria, realize that Benin is way, 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 way less cheaper. So we will come to Benin, and that is product specialization. We moving our processes there to another country because we think it's a low cost location. When we finish, we go on to the next process, the next stage, which is value chain disaggregation, where we split our production processes for a single product between different countries and the locations. So just like Apple, you realize that, oh, the charging system is being done by someone, the camera is being done by someone, the screen is being done by someone, the body is being done by someone, the battery is being done by Okay. So, as I said, just like iPhone, you know how they spread their activities, their production activities. This will be done in this country, this will be done in another countries. That is value chain disaggregation. Okay, the assembling will be done in another place or another country. So, when we do this, we move on to the next stage, which is value chain re-engineering. The re-engineering is similar to the disaggregation, just that, after we've moved the camera production to, let's say, Beijing, we realize that, after some time, we realize that, even UK is very cheap. We thought Beijing was cheaper, but UK is way cheaper. So let's move the camera production to UK. So here, we had already moved to another country, right? But we are moving again to take advantage of further lower cost. Value chain re-engineering. And because of the cost savings we are going to get from value chain disaggregation and value chain re-engineering, we tend to have the capacity to expand our market share. And that is the last point, market expansion. So that our sales in the global market will increase. Please, let's take note of this. If you didn't get it, please revise your notes on that. Okay, so we have a lot of ways that companies can enter into a foreign market. They can export, they can get license. Someone in that different country can get a license. Someone in that different country can get a franchise. They can have a strategic alliance in the sense that they will collaborate with the company that is there. And also they can have a joint venture. But please know joint venture, know the advantages of a joint venture and also the difficulties that can come when two companies join forces. We also have wholly owned subsidiaries. Wholly owned subsidiaries. So let me even quickly look at the joint venture with us. So with joint ventures, usually two companies of the same strength will come together for a particular purpose, right? And they usually do that because they want to share risk, because the amount of investment that they need is huge, that one person can't do it. So they have to get the two people on board, right? When it comes to the advantages, it might be a local requirement. Okay, I hope you guys are aware that Ghana, we have a local requirement rule, in the sense that there are some things that only Ghanaians are supposed to do. Not just Ghanaians, Ghanaian 100% owned businesses are supposed to do that. Those who have read the Petroleum Act and also who have read about the mining companies will attest to the fact that there are some operations that, as a foreigner, you can't do it alone. Because of that, if you want to come to Ghana, you have to partner with someone, right? Great. The local company management should have a better understanding of the business. It is easier to succeed by forming an alliance with a local company than going to compete with them. And also, the local company might already have customers that the products that you guys will join forces to produce will just sell to them. With the difficulties, one joint venture partner can be perceived not to be contributing adequately. Imagine you are in a partnership and you feel like you are doing it alone. You are doing the major work. Like, you might have to break out, right? One joint venture partner wants to withdraw from the partnership, and also even though they are different companies, they start to, even though they have formed an alliance, they start to compete with each other. So these are the difficulties that can arise when it comes to joint ventures. Let's move on and look at corporate strategic choices. Corporate strategic choices. Let me share my screen. Okay, so here we are looking at directional and scope strategies. If a company wants to move, grow, develop, what is the direction that they are supposed to go? And what is the extent of the direction? Okay, and this is where we are going to look at the Ansoff's model. All right, so we have what direction is and what scope is here. Then let's zoom straight into the growth vector analysis, which is also known as the Ansoff's growth matrix or the product mission matrix. Okay, so here, just like any model, we have two dimensions. We have the market and the product, right? The market and the product. Now, companies would want to, operate in the existing market with the same product. It is called the market penetration strategy. If the market is new, but the products are the ones that we already have, it is called the market development strategy. In fact, we are developing a new market, so it is fair for us to call it a market development. If the products are new, but the market is an existing market, we call it the innovation strategy or the product development strategy. In fact, we are developing a new product, so it's fair we call it product development. Lastly, if the market is new and the product is new, we call it the the diversification strategy. So please let's know these things and what the explanation of these are, okay, with respect to answers. When it comes to diversification, we have two types. We have concentric diversification and conglomerate diversification. So concentric is also known as related or horizontal, where the new product, new market area is related in some way to the entity's existing products and markets. But when it comes to the conglomerate, the new product market area is not related at all in any way to the existing products and markets of the entity. Why should we consider conglomerate? That is the unrelated, because that will help us reduce risk. If it is related, it means that there is no need or there is no reason why we should diversify. But if we really want to reduce the risk, we have to diversify. We also discussed gap analysis. We discussed integration, where we said we have the horizontal integration and the vertical integration. With horizontal integration, it is where you are acquiring your competitors. But with vertical integration, it's either it is forward integration or backward integration. With forward integration, it is also known as the downstream integration, where we acquire our customers. When it comes to backward, we are going back to acquire the suppliers who give us raw material. So we have arguments for and arguments against this vertical integration. We have other directional and operational strategies like the consolidation and stability strategies. When it comes to the consolidation strategy, it is when we say that no, We want to maintain how we are now. We don't want to increase in size. We don't want to grow anymore. We don't want to reduce to where we are. We want to maintain it. We want to maintain the market share, but not increasing it. That is the stability or consolidation strategies. Why will an entity do that? They will do that if the entity might be managed by their owners who does not want the business to get any larger. We don't want, it's our company. We don't want it to grow. We want it to be like this. And also, management might take the view that if the entity gets any better, there will be serious problems in managing the enlarged entity. So, clearly, they want to have the consolidation strategy. Okay, good. We also have the withdrawal strategy, as the name suggests. If you want to, withdraw the products or services from the market, the harvest strategy is also there. We also have the defensive restructuring strategy. We have spoken about all of these. We discussed other evaluations of SBUs. We realized that the Boston Consulting Group, the ANSOX model, is one evaluation of SBU. So we discussed the other ones. So we discussed BCG matrix, which we have already done it in, external analysis. It is similar to the public sector matrix according to Montanari and Breaker. But here we have two dimensions that there are service efficiency and also public need and support. Guys, looking at the time, you guys might have to give me, let's say, another hour, okay, so that, because today I want us to look at the whole case study, right? So that the next time we are meeting, we are talking about the case, okay? Yes. So this is saying that all these assessment or analysis of models we have been talking about relates to private sector entities who are profit oriented, right? So these guys sat down and brought something for our public sector friends. So with the public sector metrics, as I said, we are looking at how well service is being rendered by the public sector institution, and also how supportive, okay, the public is with respect to that particular public sector institution. So here we have 4 quadrants. We have the public sector star. Remember we spoke about star in the Boston Consulting Group matrix. It is the same mindset. We have the golden fleece, the political hot box, and also the back drawer issue. So the star has, as you can see, high efficiency and also high support. The political hot box is not really efficient, but they have support from the public. The golden fleece is efficient, but do not have the support of the public. And also the back drawer is low in terms of efficiency, and also they do not have the support of the public. So when it comes to the public sector star, I think that the Bank of Ghana, and I think one of our colleagues also cited DVLA as a star because that person thinks that Ghanaians support DVLA, Ghanaians need DVLA, and DVLA is also operating efficiently. When it comes to the political hot box, where the support is high but the efficiency is low, I cited the energy sector and ECG. Other people cited the ambulance service, the Ghana Railway Company, that we want the railway lines to come, right? But these guys are not efficient enough. And also the Ghana Water Company. We also have the Golden Fleece, where they don't really have our support, but their services are efficient, right? We cited the office of the special prosecutor. I don't know why, but a lot of Ghanaians do not really like that office. But I mean, so far they have been delivering, right? So you can use some of these examples, right, to let you know what the various quadrants are about. We also went on to discuss the McKinsey and General Electric business screen, where we said that these guys were also trying to improve upon the Boston Consulting Group metrics. So here we also have two dimensions: the market attractiveness and business position. These guys define what they mean by market attractiveness and also what they mean by business position. When it comes to the plot, we have just three strategies here. We have growing, holding, and investing. Just know that the diagonal part, okay, of this model is holding. Okay, anything beyond the hold is growing, and anything below the hold is harvesting. That is one way that we can use to find our way when we are drawing this. We also discussed the criticism of the business screen. So we also have the shell directional policy, which also aims to improve upon the Boston Consulting Group. So here also we have prospects for sector profitability and the competitive capability of the company as the dimensions. So we have cash generation, growth, the leader, try harder, double or quit, fixed withdrawal, custodial, and disinvest. So there are 8 strategies that are available. There are 8, even though the boxes are 9, because if you can see, the phase withdrawal are 2. Okay, they are 2, right? So we spoke about disinvest, right? Where these are companies that have weak capability in terms of competition, but and also their prospects for sector profitability is unattractive. Okay, so just like dogs, these are very weak, and also because of this, they have to be liquidated. With phased withdrawal, there is no agency for us to liquidate, but we will liquidate subsequently. Okay, with double or quit, it's like you are gambling. You don't really know the outcome of you doubling your investment in the particular company or particular SBU, or you quitting. So someone who is risk averse will quit, but someone who loves risks will double their investment, and this particular SBU might succeed. So there is also the try harder, the custodial, and also the cash generator, the growth, and also the leader. We also have criticisms for the shell directional policy metrics. We also have the asterisk portfolio display, which is also very important. We have core 2 dimensions here as well. We have the benefits and the feel. So this matrix is proposing that what are some of the things that you have to look at when you want to acquire a particular SBU, or you want to assess your SBUs, right? So you can use the benefits and the field to do the assessment. And it's out of these 2 dimensions that we have the ballless businesses, the alien businesses, the value trap businesses, and the heartland businesses. So with the benefits, we are looking at the value the business can add to the potential SBU. Since you're hearing benefits, don't think about the benefits that you, the acquirer, is going to get from the business you're going to acquire. No. Think about how you're going to help that particular business. The particular business you're going to acquire, how are you helping that business? And that is the benefit. With a feel, we are looking at how the culture, the industry that you are in aligns with each other. Okay, great. So if the fuel is high, it means that you guys have the same industry, or you're in the same industry, you have the same culture, you have the same direction, you have the same structure. If it is low, it means that you don't have these things. Okay. If the benefit is high, it means that that particular SBU that we are going to acquire needs us. They need something that we can provide. So they are going to benefit from us. We are not going to benefit from them. So please take note of that. So let's revisit the types of the SBUs here. We also went on to discuss what Gold and Campbell discuss as parental styles. Okay, so just like our parents, some companies are also parents, especially the head offices. They are parents to the branches and the SBUs, right? So there are about three styles that they use: the financial control style, the strategic planning style, the strategic control style. So these are some of the things that they use. We discussed about them. So with the financial control style, the parents will act, you know, on behalf of the shareholders. They will set performance for the SBUs. They look at how well they are doing with respect to the performance that have been set to them. And in as much as they are doing all of those, they try to make sure that managers of the branches or the strategic business units are autonomous, okay? Meaning that they have the authority to make their own decisions. Some of these parents also employ the strategic planning style. So these guys come in and ensure that there is synergies among all these strategic business units. Are you doing something that if we add you to another person, you do better? That's what the strategic planning style will be thinking about. So as you can see here, if company A is doing 10,000 Ghana cedis, company B on his or her own is doing 30,000 Ghana cedis. If we add their individual contributions, that will be 40,000 Ghana cedis. But because of synergy, if we add them together, okay, their contribution might be 100,000 Ghana cedis. And that is the work of the strategic planning style. Lastly, we have the strategic control style, where the parent builds and maintains value by providing its own resources to the SBUs. So this will be like um how do I even say it? Like a hen, a chief hen who has chickens, right? So you know that the hen might go and pick food, come and bring it to the chicken, or let's say birds, right? So here they will kind of be feeding you. There will be seasonal opportunities for you so that you just take advantage of the opportunities. Okay, so we also learn how value can be added through corporate parenting. We also learned that sometimes, in as much as the corporate parent is trying to help us, they do us doomful comfort. Sorry if you don't understand Chi. What it means is that even though they are helping us, they go a long run destroying the value that they have created for us. And what are some of the values, or what are some of the ways that value can be destroyed? When they charge high administrative cost, you are helping us. You are charging us more than someone or an independent person would have charged us. That won't be fair. That will destroy the value that you are trying to create for us. And also, if there is increased bureaucracy, it can slow down decision making. Every time you might have to go to the head office to go and seek permission. That will reduce decision making. And please know that these are corporate parenting styles, and it should be different from the corporate rationale. Corporate rationale, we have the portfolio manager, the synergy manager, and the parental developer. So let's know what these are, and we are going to be fine. Okay. So let's talk about the next chapter. which is competitive strategy and strategy development methods. Strategic. All right. So here too, we are looking at these two guys, Michael Porter and Bowman. So we're going to look at the Bowman's clock and also the Porter's generic competitive strategies. Okay. All right. So, we are all aware of this. We are all aware of the generic principles where we have the cost leadership, the differentiation strategy, and also the focus strategy. So, with the cost leadership, okay, it means that a company wants to be the lowest cost producer in the market. So the least cost producer can compete effectively on price by offering its products at a lower price than rival products. This is similar to low price and no frills when it comes to Bowman's strategic clock. So we are going to look at that very soon. So these are some of the things that companies are supposed to do when they want to be the cost leaders. They are supposed to have excellent systems of cost control. They are supposed to continually plan for further cost reductions. At every point in time, they are doing something to reduce their cost. Can you match them? You can't. Because every day, instead of their prices to be going up, it is going down. And they are becoming competitive every now and then. Also, large firms will have economies of scale and also, especially when they buy in large quantities. That is the cost leadership. When it comes to the differentiation strategy, we are making our products different from rival firms. That is all. We are making our products different from rival firms. So a cost leadership and a differentiation strategy can be pursued in a market that is not segmented. Immediately the market is segmented, we come back to what we call the focus strategy. So focus strategy is not really a new strategy. It is just indicating us that or telling us that, oh, it is not a strategy employed in an overall market. It is a strategy employed in a focused market or a segmented market. Okay, good. So with focus strategy, we are concentrating on selling the products to a particular segment of the market and to a particular type of customer, right? Even with that, we will either employ the cost leadership or the product differentiation. Porter also highlighted the principles of strategic positioning. So he mentioned that to achieve sustainable competitive advantages, companies are supposed to take into consideration these 6 principles. So the strategic goal for a company should be to achieve a superior long-term return on investment. The strategy must offer a unique value proposition for the customer. There should also be a distinctive value chain. That will mean that the selected strategy will involve some form of trade-offs. All the different elements in the strategy and in the value chain should be linked with each other and complement each other. And lastly, there should be continuity of strategic direction. So these are the 6 principles of Michael Porter when it comes to strategic positioning. We also have target market, as the name suggests, you are targeting a particular market. We have the market niche, and also we have leaders, followers, and challengers. So leaders will sell most of the products, they will be market leaders in the company. Followers, they do not really have any ambition taking over the position of the leader. So usually they will just follow the lead, the footsteps of the leader. The challenger has ambitions of becoming the leader. So they also do their part to become leaders. And also the nature is just like the focus differentiation, where they target a particular market segment and sell their products to them. So Bowman in 96 also suggested a clock for us to follow. There are strategies, about 8 of them under this clock. 5 of them will work, 3 of them do not work.
Oh boy.
They do not work because of
That's right.
3 of them do not work because of where they are positioned, right? So in this strategic clock, we have 2 dimensions. We have the perceived benefit that the customer thinks they are going to get when they buy the product, and also the price. Okay. So if the price is low and the perceived benefit is low, it is called no frills. All right. So we have the explanations here. So no frills will have low price, low perceived benefits. Also, low price strategy will have low price, but here the perceived benefit won't be low, it will be average. Okay. With a hybrid, the price is below average, but the benefit is higher than average. And also with the differentiation, the price is average and the benefit is very high. With the focus differentiation, the selling price is higher and the benefit is also higher. Right. The other products that we sell will fail. They will fail because the products with perceived benefit that are below average cannot be sold successfully when there are lower price products offering the same thing. Okay, so look at this. You are here. You are selling at an average price. The benefit that I am getting is low. Why will I come and buy? While I am getting no frills here. Who is selling at the same benefit you are selling, but at a lesser price? Everyone will come and buy from the no frills. And that is why this area will fail. This area will fail. This area will fail. So these are strategies that will fail. Right. So we also moved on to look at strategic development methods when the company wants to expand. What are some of the things that they can do to expand? So there is a method called the do it yourself or the internal growth or the organic growth. We have the growth that we can achieve through acquisitions and measures, and the one that we can achieve through joint ventures and strategic alliances. So with the do it yourself method, we are depending on our own resources, whether income surplus or what other people call it retained earnings, loans, and any other funds that we are getting to improve upon our sales and profit for the year. So there are advantages, okay? It is easy for us to get that money because we don't really have to go and sign agreement and things. No. The entity should be able to focus on its core competencies and develop these to grow successfully. And also, if the entity finds that it is short of a key labor, it can buy the labor skills it needs by recruiting youth. When it comes to the disadvantages, there's obviously a limit to the rate of growth because if you have to grow by 20%, but the funds that you are having, you don't have that 20% money, 20% growth money, you'll be limited, especially if you want to depend solely on the money. Also, to expand a business beyond this limit of its current capacity, it is necessary to invest in a new capacity by either acquiring it or you'll be merging with another person. And with this do it yourself method brought us the grayness model. So this has also seen an improvement. There has been an improvement in the grayness model. It used to end at phase 5. Now we have phase 6. So let's take note of that. So this is saying that when companies start operations, when they start like entrepreneurs. They start and grow through creativity, right? It will get to a point that they will need leaders. They will need senior management to take over. So if you check the top of the diagram, we have phase 1, which is the growth that is happening. Now, the crisis is the circumstances that will come for us to have a change. Remember, we spoke about drivers of change, right? So that will come and tell us that
They are
no,
fighting, please.
chicken man, pizza man cannot
You
be
were flowing.
the director. I mean, he started as an entrepreneur, so the creativity stage will come, right? It will get to a time that you realize that no, I need an accountant. I need someone to be in charge of the food as a chief chef. I need someone who is a lawyer who can help us when it comes to the legal issues. Chief legal officer. I need someone who will be in charge of health and safety. I need someone who will be in charge of marketing, right? So this crisis will bring on board the new phase, which is the growth through direction. So the company will grow, from the creativity side to a directional side because now we know that we have directors or people who are leading the company. Now, Chicken Man Pizza Man has a lot of branches. Let's say there are branch managers everywhere. Every time there is a decision to be made, the branch managers will have to call the directors or those at the head office that we need it. So we need to go and buy pepper crab. We have to call them. That will bring some form of bureaucracy in the system. So the branch managers will fight for autonomy. That why do we give us managerial roles if we are just here looking at the staff? We want to make decisions ourselves. So give us control, give us the power to make decisions, right? So the crisis of autonomy will come because the branch managers will be yielding for control and autonomy to make decisions. Now, the directors will say that, oh no, okay, no problem. Let's just give them the autonomy that they need. And they'll give them the autonomy. So this phase will pass and we will have a growth through the delegation because we have delegated to the branch managers to operate autonomously. Now, they'll be operating for some time. The head office people will be there, the directors will be there. They realize that these branches are doing things. Then they'll tell themselves that, these guys, now we don't even know what is going on. We've lost control. They make decisions themselves. We are just here chopping money. So let's just go and grab some of the control again. So there will come the crisis of control that the directors will be complaining about, that they don't have control because they have handed it over to the branch managers, right? Okay. So now they'll go to them and tell them that, hey, you know what? Like, we are not doing anything. You have taken all the powers. So let's get it back, okay? Now they will say that if you want to do anything, we are saying that bring your own decisions, okay? But let us approve for you. You get it? Let us coordinate all the branches. Now the growth through coordination will come. When the growth through coordination will come, it will bring on board another bureaucracy in the sense that everything might have to go to the head office again before the approval is done. And that will bring on board the crisis of red tapeism or red tape. Now, when we get there, we will cross by saying that, okay, now let's take decisions together. Let's collaborate. We can't take decisions alone. Whenever we want to make a decision, we will involve you as branch managers. So it's not like you're coming to come to ask for approvals, and no, we will involve you and take the decisions together. So we will collaborate, and when we are collaborating, we'll be forced to grow. That will be the crisis of growth. So if you can see this crisis of question marks here, last syllabus it was here because we didn't have phase 6, but now we have phase 6, which is the growth through alliances. That sometimes our own, as we said, will be limited with our internal funds, that we might have to create alliances with other companies, either through joint ventures, acquisitions, or measures, for us to get the growth that we want to get. Okay, great. So I think I've explained everything here. Okay, so we also have acquisitions and measures. I mean, we all know what they are. We should know their advantages and disadvantages. We have also discussed strategic alliances and joint ventures in our earlier studies. So quickly, let's run through FM. Then we will run through corporate governance. Unfortunately, we can't solve the FM questions I promised today, but God willing, when we meet to discuss the case, we will look at all of them. Okay, so quickly, let's look at financial strategies and financial options. And please, I am going to run, okay? That is because most of us have done FM. All right, so here we are looking at FM, sources of finance, capital structure, investment decisions, international financial management, and treasury management. The aspects of stakeholders are things that we have already discussed. You know, you should be aware of the conflict between the stakeholder objectives, as we have discussed. Sometimes there are incompatibilities. Okay, it's a extent that, you know, helping one stakeholder might be that another stakeholder will come and fight with you. So, as we said, we have to take into consideration the stakeholder mapping to know which is powerful or who is powerful and whose interest we should, maximize. Then we will come to the theory of agency as proposed by Jensen and Mecklin in 1976. So these guys are saying that companies have shareholders. The Companies Act called them I've forgotten. Don't worry, let's move on. So these shareholders are agents. Sorry, directors are agents of the shareholders, right? Good. They are supposed to act on their behalf. Every interest should be their interest and all of that, because usually shareholders might not have the expertise of running companies. That's why they will have to bring on more directors. Okay, they might not even have time, but when they come, some conflicts okay. Moral hazard, effort level, earnings retention, risk aversion, time horizon. These are some of the conflicts that are okay. Let me quickly explain them. So, with the moral hazard, we are saying that since the owners are different from those controlling the company, the owners have the shares, the managers, the directors do not really have shares. So, they don't really care if the business collapses. They might take decisions that are in their self interest, okay, because they don't have shares in the company. So, we are saying that for us to reduce this conflict, we should get directors, senior managers, shares, so that they will feel belonged. They'll feel like, oh, this is also my company. I have 2% shares. You get it? So that they will act in the interest of the company. We also have effort level where we say that I don't have shares in the company. Why am I supposed to work so hard? After all, I don't have shares. And if the company collapses, I'll go and look for another job. You get it? But if you have shares in the company, the probability that you will work harder is higher. than if you do not have shares. We also know, or we also have earnings retentions. Sometimes directors will be promised bonuses when they expand or develop the company. If you remember, we said that one way of developing the company is using the do it yourself method, the internal growth. So they're going to depend on the retained earnings, right? Now, it is the same retained earnings that companies are supposed to pay dividend. Shareholders will be there looking forward to get dividends from the company. You also be there saving the money that I want to do expansion because my bonus have been tied to the expansion. I hope you get the conflict I'm trying to paint. Now, the other one is risk aversion, especially if one of the parties love risk. Maybe the shareholders love risks, but the directors do not want to take any risks. So, because if the company collapses, where am I going to work? Other times too, the shareholders will not love risk, but the directors will love risk. So that's the risk aversions. These are conflicts that happen as a result of the agency relationship. Then we have the time horizon. Sometimes shareholders will want something that will add long-term value to them. But is that what key management personnel want? No, they want their bonus to increase right now. So they will do things that we call short-termism, things that will improve upon their profits, even though that won't improve upon their long-term value. It will improve upon their profit today. That will make them enjoy the benefits that they want to enjoy. We also have the agency cost. Since we have decided to get directors, we tend to incur certain costs. The cost of monitoring them by employing auditors, the cost that the shareholder will pay when the managers take decisions that are not in their best interest, and also what we call bonding cost. Sometimes say, "Oh, Enoch, how are you? Oh, Fred, how are you? Okay, okay, okay. You know, I want you to take decisions on my behalf, decisions that will go into my favor. You get it? So, let me increase your salary small, right? Bonus packages, incentives that will incentivize these guys to take decisions or decisions that are in the best interest of the shareholders. So we discussed really like how we can reduce the agency problem. We also spoke about ethical problems and financial strategy. We wanted to look at capital budgeting, investment appraisal. We discussed the ARR, the payback period, the discounting payback period, and an introduction to the syllabus is the EVA and the SVA, where we discussed the shareholder value analysis and the economic value analysis. So we looked at the formula and all of those things. We also discussed lease or buy. As I said, I'm not really going to spend a lot of time here. We spoke about working capital and liquidity management. Um, we also went on to discuss international financial management, where we started off by looking at the factors restricting foreign investment. One key aspect is the exchange rate risk that is available to these companies. We also went on to look at the exchange rate or currency risk, where we said that it brings about translation risk, transaction risk, and a long-term risk, which is known as economic risk. Translation risk in the sense that if you are dealing with or you're dealing in a particular currency that is not your currency, you have to translate it at the end of the period, right? According to IAS 21. Okay. And likewise, when it comes to transactions, right? One key example that I use is that imagine we buy something today, right? And we decide to pay it 2 days or let's say 2 months later. When we buy the thing today, the accountant will say that we have to debit the particular expenditure item and credit accounts payable because we haven't paid it yet, right? So let's say we bought it in dollars. So when we bought it, we converted it. Let's say when we were buying it, the CD to dollar was 10 cedis. Now we converted it. So $1,000 times 10 cedis. That will be 100,000 Ghana cedis. We recognize that in our books. Now we are supposed to make payment in 2 months' time. As at the time we were supposed to make the payment, the CD had depreciated to, let's say, 15 cedis. Remember that we have already recognized 10 cedis in our books. So the accountant will recognize the accounts payable that we credited, right? So we will debit account payable with the 10,000 because that is what we recorded in our books. We are going to use cash to pay. So we will credit cash 15,000 because now we are supposed to make 15,000 Ghana cedis, even though as at the time we bought it, it was 10,000. Now we will have to recognize what we call foreign exchange loss of 5,000, which is also a debit to balance the equation. Mind you, we haven't bought anything. No. We are incurring additional 5,000 Ghana cedis because of transaction risk. You get it? Right. We also have political risk. That is the imposition of taxes and the risk that private companies will be nationalized. We have physical risks that relates to taxation and international investment. We also have exchange controls. Sometimes it is very difficult to even remit monies out of the company you're going to invest in. So we discussed foreign exchange risk. We looked at some examples when it comes to currency transaction exposures. We spoke about transfer pricing. So let me talk a little about transfer pricing. So let's say we have divisions in a particular company, right? Division A is being headed by Richmond. Division B is headed by Victoria. Division A sells what Division B wants. We are in the same division. I mean, we are in the same company, but different divisions. We all have a divisional targets that we are supposed to meet, right? Now, the price at which Richmond will transfer things or transfer goods to Victoria, if Victoria's division needs those goods, is what we call the transfer price. So the price can be below the market value or above the market value or the same as the market value, depending on the intention of the manager doing the transfer. Okay. So we spoke about transfer pricing. Obviously, we have a selling division and a buying division. One thing that we should take note, the objectives of transfer pricing. The first objective is to achieve goal congruence. And also the next one is to give autonomy to the managers of these strategic business units. Please take note that when there is a conflict between goal congruence and autonomy, goal congruence take the comfortable lead. Okay. Okay. So we also have treasury management. That is where we spoke about forward FS rates. So in our next meeting, we're going to solve examples on these. In fact, we have already looked at them already. So we will solve examples on them. I wanted us to do it today, but it looks like I've talked plenty. So we have forward exchange contracts. We have premium and discounts, interest rates, risks. I mean, we have discussed all of these. Please, if you don't seem to remember, please write it somewhere and revise it. Okay. So we also went on to look at financing options. So we spoke about sources of finance, the short-term funds, the long-term ones. We also discussed internal sources of finance and dividend policy. we have already looked at the limitations when it comes to using retained earnings. We want to look at raising new capital externally, especially equity, where we can have initial public offer. Okay, so the shares will go to the stock exchange for the first time. We can have placing, where we target relatively small number of shareholders and get them the share issue. And also the right issue, where we give existing shareholders the right to buy the shares that we want to issue before we send it outside. We also discussed the use of debt capital. We looked at the fact that it can be from banks or it can be bonds. We looked at the advantages of getting a debt finance to the company and also to the investor. We also looked at the disadvantages. We spoke about leases in accordance with IFRS 16. We also discussed convertible bonds and also bonds with warrants attached. We discussed gearing, operating gearing, and finance gearing. Right. So quickly, before I take most of your time, let's quickly run through corporate governance so that our next meeting will take the case, disintegrate it, and also solve questions on financial strategy and financial options. Okay. All right. So we ended our lectures on corporate governance, and that is a very big issue, especially in Ghana. So we looked at how different governance is from management. We realized that management is in charge of the day-to-day running of the business, but really, governance or the people in charge of the governance are supposed to, check or to be a check to management. Okay. We said that value can be created in different ways. Value can be measured in different ways. It can be measured taking into consideration some financial indicators like the total market value, profitability, and what's not. Value can also be measured by looking at the benefits that the company is offering to some of their stakeholders, like employees. How are you developing your employees? How are you helping them, and all of that? Value can also be measured by taking into consideration how your operations are damaging the environment. So it is out of these value creation that people have a lot of ideas and mindset when it comes to values. Some people wants to look at the shareholder value approach, where they say that, oh, as a company, we are set up to maximize the value of our shareholders. That is why we are set up to do. And also we have the stakeholder value approach, where companies are governed in a way that focuses on maximizing value for almost all the stakeholders that they have. Now, we also have the enlightened shareholder approach, which looks at maximizing the value of shareholders and also recognizing that, oh, we have other stakeholders that we have to look at. So let's look at them as well. We discussed separation of ownership from control and the problems that come out from the separation of ownership and control. We also looked at the director's duties in accordance with Section 190 of Act 992, where we said that a director shall act in what that director, in what you believe is the best interest of the company as a whole, so as to preserve the assets,
further business and promote the purpose for which the company was established in a manner that is faithful, that is diligent, that is careful, and that ordinarily skillful director would act in the circumstances, and in doing so shall have the regard for the implication of the decision in the long run and not just the short run, the impact of the operations on the environment and the community, and also the desirability of the company in terms of them maintaining their reputation for high standards of business conduct. These guys also have some powers, and the powers are usually exercised by appointing management, key management personnel to operate the company on their behalf. We also discussed some corporate governance issues, which we explained in the further concepts or further slides or notes. What other things are we supposed to know? So we discussed corporate governance in other sectors and other institutions like the public sector institution and also charitable institutions. We also looked at the concept of good governance. So please take notes when the examiner asks you about the concept. It is fairness, transparency, independence, honesty, and integrity. We also have responsibility and accountability, and lastly, reputation. We also discussed some corporate governance theories. I mean, we had already looked at agency theory, so we didn't really go into it. So we discussed the other theories like the transaction cost theory, which attempts to explain companies not just as economic units, but as organizations consisting of people with different perspectives and mindsets. Okay, so we are deciding what transactions to undertake as a company, whether we are supposed to buy, we are supposed to make certain things. Okay, great. We also have the stewardship theory that acknowledges that the directors of a company have a stewardship role. They are supposed to take care of the assets of the company and manage them on behalf of the shareholders. We also have the resource dependency theory that also looks at how resources of the company affect the governance and the behavior of employees. We have the managerial hegemony theory and the class hegemony theory. So the class hegemony theory considers the business elite as a group of individuals who control the governance of companies to perpetuate these power base. Management hegemony theory, on the other hand, argues that the real power in corporate governance lies with management and that they can take advantage of shareholders' weakness to pursue their self-interest. So what I'm saying is that the class hegemony is saying that people who are very elite in terms of business, they become directors. And when they become directors, they take advantage of companies. You get it? But the management hegemony is saying that no, 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 it's not just directors, or it's not even directors, it's management, because directors also delegate power to management to act. And these management acts, they know the weaknesses of the shareholders and they take advantage of them. We also have the psychological and organizational perspective theory and also the stakeholder theory. I think we have discussed that already. We also have the system theory that proposes that the company is an overall system consisting of interlinked subsystems. We also looked at the role of the board of directors. We also discussed the principal duties of the board. We discussed the composition of the board. We said that we don't really have any standard or any law giving the composition of the boards, right? But there are some boards that are backed by law. I think when I was teaching this, we went to look at the Independent Tax Appeal Board of Ghana. So the criteria is there. People who are supposed to make up the board, 11 people. Okay. The first one should be this. There has to be an ICAG rep on it. There has to be a CIT rep on it and all of that. Those are there. But usually, when it comes to private sector companies, we don't really have an ideal number. right? But usually we'll have a chairman, we have a CEO or an MD who will be an executive director. We'll have other executive directors and also other non-executive directors. So, usually we admonish that the role of the chairperson of the board and the chief executive director shouldn't be the same person. We discussed the role of the managing director, the role of the board chair. We found the comparison between the two here. We also discussed some people that we call NEDs, non-executive directors, that they come on board. They are non-executive directors because they don't have any managerial role. Okay, so we said that any management who is on the board is called an executive director. Let's say MD. The MD is part of management, right? If the MD is appointed on the board, the MD is known as an executive director. So we looked at the role of non-executive directors, and also this role was identified in the Hicks guidance in 2003, where we have strategy, performance, risks, and people. We said that when new directors are onboarded, they have to be trained and inducted. Even existing directors are supposed to be trained so that they will always have or be on top of their game to help the company achieve their goals. Some people criticize non-executive directors to the extent that they think that they might not have knowledge about the company and the business that they are directing. They might not get time for the company, and also they might just go and sit there and accept the views of the executive directors without critically criticizing them. Some non-executive directors are independent, and we looked at how or what will make someone an independent non-executive director. A non-executive director means that the person do not have any managerial role. The person who is being defined as a non-executive director will be called as an independent non-executive director if they have no link to a special interest group, if they have no significant personal interest in the company, if the person is not a substantial shareholder of the company, if the person has not been employed by the company in any executive capacity for the preceding 3 years before the person was appointed, if the person hasn't provided any professional or consultancy services to the company. Okay. Right. So, as I mentioned when we were starting this class, board sometimes have committees, and these guys do not have decision-making powers, right? They just go there to go and discuss issues and bring it to the board for the board to conclude. So the committee will be dependent on the client, right, or the company. So usually companies have remuneration committee, audit committee, nomination committee, risk management committee, and whatnot. As I said, it is dependent on the business, right? We also discussed the components of remuneration packages for senior management and directors. What else did we look at? We also discussed the role of institutional investors in corporate governance. We discussed the role and duties of the external auditors, the functions of the audit committees. We discussed internal controls, where we said that they have been grouped broadly into three. That is the financial risks, operational risks, and compliance risks. Compliance risks, we are looking at the risks that the company will not comply with any regulation that is surrounding the activities. With operational risks, we are looking at the risks that there will be errors or mistakes in the operations of the company. And with financial risks, we are looking at the risks that the financial processes and procedures will fail. Okay. So we also discussed some of the nature of internal controls, that is segregation of duties, physical controls, authorization and approval, supervision controls, and lastly, arithmetic and accounting controls. We also looked at some of the things that will bring weaknesses in the design and the operational effectiveness of controls, human errors, management override of controls, breakdown in control system, and unforeseen circumstances. We also discussed the OECD principles when it comes to corporate governance. We looked at the content of the OECD principles. We looked at the first principle, second principle, to the sixth principle. We also discussed the role of the accountant in corporate governance. We discussed corporate governance in Ghana, where we started off by looking at the SIGA, which is the State Interest and Governance Authority, that we said that their role and responsibility is to promote efficiency in terms of our profitable operations in Ghana. Okay, so we call them specified entities and we mentioned state-owned enterprises, joint ventures that the government has interest, certain regulatory bodies, and also development partners. Once again, this is a new area that the examiner has introduced, so let's please be mindful of it. So we have the responsibility of the SIGA here, that they supervise and administer the state interest in specified entities, and also they ensure that specified entities introduce effective measures that provide social economic growth in Ghana. We also spoke about the Bank of Ghana Corporate Directive when it comes to corporate governance. It was, rolled out for rural and community banks in 2021, and also with our normal banks and savings and loans, it was rolled out in 2018 but revised in 2022. We also have some items of corporate governance that the Companies Act, mentions. Okay, so these are the things that the examiner is supposed to, or the examiner wants us to know. And lastly, we have the Ghana Corporate Governance Code for listed companies. So here we're just looking at listed companies. So we discussed the board of directors, their role, their composition, the fact that they should have a board secretary, how frequent and how often they are supposed to have their meetings, and how information is circulated among management and also directors of the company. We also looked at the directors of the company, where we looked at appointment, multiple directors, re-election of directors. These are listed entities, right? So in our case, if we realize that the company in the case is a listed entity, then if they ask any corporate governance issues, we can state some of these things, that directors should be submitted for re-election by the shareholders every 3 years. There should be induction. If they are going to be dismissed, they should be done well, and also the removal should be disclosed in the annual report. We should talk about their remuneration and also the roles of the chairperson and the CEO. So that same code for listed companies also mentioned the establishment of the board. So some of the board's financial statements and controls, relationship with stakeholders, where we talk about the fact that the directors are supposed to constantly communicate with stakeholders, especially shareholders, right, through annual general meetings and whatnot. We also have the National Corporate Governance Code 2022, and this is also a principle-based code, and it is voluntary. It was developed by the Institute of Directors, and it has 3 core principles, which is known as the PAR: patriotism, accountability, and responsibility. It also has 5 governance pillars, which is known as or whose abbreviation is PLCGH. So the P is purpose, L is leadership, C is controls, G is genuine disclosures, and the H is humane engagement. Now, there are also 14 fundamental governance principles. And lastly, there are 71 general principles. Guys, let's know these: the 13 fundamental principles, the 5 governance pillars, and the 3 core pillars. Because these are new areas that the examiner can bring anytime. If you guys remember the PEFA framework, this one works exactly as the PEFA framework. We might not be asked to go into details, but the examiner will ask us to mention, let's say, 5 fundamental principles out of the 13 fundamental principles in accordance with the National Corporate Governance Code 2022, which is also known as the National Code. All right. So, it has been a long day for us. I'm sure some of you are stressed, some of you are tired. I hope this revision was necessary and it was reasonable for us, and it has been helpful. Okay, it has given us areas that we have to set up and areas that we think we are okay with. Please, however you are feeling at this point, please don't give up.